thing I wanted to talk about is that this meeting is being recorded. And so keep that in mind. And also notice to everybody that there's a video of this meeting. So the next thing, Savannah, can you do a roll call for the board?
Absolutely. Good afternoon, Mr. Chair and members of the board. Jack Prothrow,
Here.
Cindy Yunkin,
Here.
Porter Bennett,
Here.
Tim Kober,
Here.
Maggie Peterson, Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost.
Here.
All right, we don't have any appointed legislative liaisons at this time, but we have 7 voting members present. We have a quorum. Thank you, Mr. Chair.
Thank you, Savannah. So the next thing I want to talk about is call for public comment on any issues within the board's jurisdiction. So is there any public comment? Now is the time to do it. Seeing none, we'll move on. The first thing we need to do is approve the board minutes for the December 6th and 7th meeting. Is there a motion to approve those minutes as printed in the book?
I'll make a motion.
Okay, is there a second?
I'll second.
Moved and seconded. Is there any discussion or corrections? If not, I'll call for a vote of the approval of the minutes. All those in favor say aye.
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 Is there anybody opposed to the approval of the minutes? Same sign. Hearing none, the minutes are approved unanimously. We have some administrative business. So we have a report, first of all, from Mark on the audit committee.
Okay, thank you, Mr. Chairman. The audit committee met today. Absent was Maggie Peterson. We welcome Porter Bennett to the committee. And the executive director was absent. That's why the meeting went so quickly. First thing was Julie Feldman went over the audit checklist. It's transferred over to show our fiscal year 23 year. Nothing new there except for our annual report and our annual audits have been posted so that they are available, even though the Legislative Audit Division has not done a public meeting to approve the legislative audit reports. They are posted. The SOC audit, they had an entrance comp meeting with Whipley on just yesterday on the 21st. They expect to start their work in March. They're going to do a walkthrough in June and do their testing in July. So that's on its way as well. As I said, the financial statements for the UIP, Unified Investment Program, and the Enterprise Fund for the fiscal year ended June 30th of 22 have been posted, and they were posted with an opinion date of December 1 of 2022, and they were audits. There were no findings in the reports, so they were unmodified audit opinions, so that's all good. The last thing that we talked about was the ethics statements. All staff had signed the ethics policy statements. That's required annually. They also asked our board members to sign those as well. And Savannah sent out a DocuSign to get that signed and approved to everybody. And with that, Mr. Chairman, that's all that I have to report to the audit committee.
Thank you, Mark. Any questions for Mark? If not, we'll hear the report from the loan committee. Jeff, I'll turn it over to you.
You bet. The loan committee met this morning. We reviewed 2 intercap loan requests. One was for Drummond Public Schools, $1.1 million. The other was for Yellowstone Mountain Club Rural Fire District, also for rounded $1.1 million. Both loans were approved by the committee, which will bring them up to the full committee here for formal approval.
So Jeff, I think loan committee can approve them from 1 million to 5 million.
Okay,
Isn't that-
okay.
Isn't that correct? And then the full board was over 5 million.
Yep.
So Dan, is that correct?
That's correct. So with the agenda should not have decisions by it. They were both right around that 1.1, 1.2. So the loan committee's approval is all that's sufficient, all that's necessary.
So it was, but we still need the notice. So thank you, Jeff.
You bet. Thanks.
Anything
was
else?
all.
Anything else for Jeff? Any questions? If not, we'll move on to HR committee. Maggie is the chair, but she was not there today, so Dan was able to chair that meeting. Dan, do you have any report?
There's not much. It was a very short meeting. We had a couple of issues that apply to staffing levels directly, so we went offline to have that quick discussion. We asked for public comment and there was none, and we closed the meeting. That was it.
Okay, any questions for Dan? If not, we'll have comments from the pension board members. Maggie isn't here, so we'll do that at the next meeting. But Dan, do you have any report from teachers?
We're actually meeting Friday of this week. We haven't met since the last meeting of the Board of Investments. So there's not much. We are following things going on at the legislature too. There's, I think there's one potential bill out there that would create a new tier of retirees with a 0% cost of living adjustment. And I believe that we testified from an informational standpoint on that one. But in terms of other things, there's nothing new going on.
Okay, thank you. Normally we'd have comments from board liaisons, but with the legislature in session, we don't have the ones appointed to us yet. Dan, do you know when we might hear on appointments in that realm?
No clue. Typically, we don't get those till the end of session when they start doing interim committee appointments. So I'd say by the May meeting, hopefully.
Okay, good. So that's all that we have under tab 1. So if everybody would turn to the book and go to tab 2. Tab 2 is executive director's reports. So I'll turn it over to Dan.
Thank you, Mr. Chairman. Didn't have any requests from the prior meeting. You do have the monthly snapshot in front of you for, I believe, January. Yeah, so you have the 131 snapshot. You also have my annual memo on disaster recovery and emergency preparedness. I'll be reaching out to Department of Military Affairs to come over and consult with us later this year. We can say we're good, but I'd leave it to subject matter experts to tell us what we're doing right and where we can be better. So we will do that. And from the custodial bank relationship and continuity perspective, I would personally, I'm very pleased with State Street at this point in time. I think they are very responsive. I think that you're never going to get 26 billion right all of the time. So when we have issues arise, they're on it. We're able to bring matters to their attention. The piece if there was an area of concern, it would be that, their recruitment of additional staff and support for the folks working on our account is going to be a critical component of their continued success. And that's something I've discussed with Bob Dollar, my counterpart at State Street. We're discussing the triannual now. We're looking at doing one one with them on site to sort of do a back, sort of a, I don't want to call it a due diligence trip, but sort of a kick the tires, make sure everything's okay at their shop, one remote, and then one with them on site. So we'll get those mapped out for the year fairly quickly. Otherwise, Mr. Chairman, happy to answer any questions the board or others may have about continuity, disaster recovery, or our custodial relationship.
Any questions for Dan? Geez, we're gonna get through this pretty fast today. That's good. So I think with Dan's report completed, we can go to tab 3, investment policy statements. I think John Romasco and John Putnam are gonna give us that report. And I just wanna say to John Romasco, I appreciate if you didn't pick on the new chairman right away.
That's never been my experience with John Romasco, but good luck. So thank you, Mr. Chairman. As you said, tab 3, you can see the memo we have here before you with some proposed changes to the Montana State Fund investment policy statement. As most of you know, State Fund is our largest separate account, Montana's largest work comp insurer. Fairly recently, so last July, Lanny Hubbard retired and Holly Odell, their new CEO, took over. And we kind of used that as an opportunity to take a look at their portfolio with their staff, with Holly's staff, and look for areas of improvement. And so it's been a fairly long process here over the last 9 months or so. But we have 3 primary changes that we're asking for the investment policy statement. We got to this place through discussions with State Fund, as I mentioned, in addition to doing a lot of work with RBK and with State Fund staff to kind of analyze, what did these changes mean in terms of their portfolio, in terms of their maintaining their risk-based capital ratio, their RBC ratio. RBK was very helpful in that respect. They have Greg Cantor on staff with them that is very good with all the insurance company stuff. And so that was a huge help to help us kind of triangulate whether we were going to have any kind of unintended impact with these proposed changes. There was virtually none. So all of these changes, when you kind of added it up, it was a very minimal impact on their overall RBC ratio, well within their tolerance, and keeps them in good stead with the insurance commissioner going forward. So the three changes here are to change the high yield asset class to non-core fixed income, which is consistent with what we do in pension fund and trust fund. And so really it's so that we can, in addition to high yield, add convertible bonds as an option for investment with their portfolio. And I've listed, kind of the rationale for each of these below in the memo. Second big ask is real assets. Again, those of you that have been here for a bit are aware of our push into real assets, and we've done so within the trust fund portfolio. Consistent with that same theme, we feel like real assets is a good place to diversify the portfolio, but also to continue to get some yield. And then finally, changing the investment grade fixed income benchmark to the full aggregate benchmark rather than the intermediate benchmark. So basically it's extending the duration of the portfolio, or our ability to go into longer duration securities. Some of you may remember back in 2020 when we made the change and added high yield to this portfolio, we might have talked about the fact that we considered doing this previously, but interest rates were so low, close to zero, that we felt that it was not a good time to be taking a large duration bet and changing the index at that point in time. Well, times have changed, obviously, and interest rates are much higher now. So we do feel like it's a better time to make that shift, and that State Fund can take advantage of the higher rates locking that in for a longer period of time. And it makes sense because it's more consistent with the cash flows that they realize coming out of their portfolio. So with that, maybe I'll stop there and just see if people have questions about the proposal, and happy to answer anything.
John, did you present this to State Fund already, and are they in agreement with all
We
these
did,
things?
yes. Yes, we did. Thank you, Jack. Unfortunately, it didn't quite sync up the way we might have liked previously. So their board meeting was just after ours in last December. But we did take this to their finance committee. They took that then to their full board, and they have expressed support for this change, both the staff and the full board.
I have a couple of questions, if I may.
Certainly, Mark.
Okay. Looking at the material here, especially when the part about non-core fixed income. In that document, item 4A, investment guidelines, you changed to include non-core fixed income as defined as strategies primarily invested in high yield, debt, convertible debt, preferred securities. Just out of curiosity, so you're talking about staying in some high yield, and you're also talking about adding convertible bonds. But you're not breaking out what the percentage is within the high yield. Is there a reason that you didn't specify anything there? Because you do that with the real assets. That's why I asked the question.
Yeah, I guess I would say, it's probably a little bit market dependent. Current intent would probably be, so there's a 7% limit on non-core fixed income. We're probably about 4% in high yield right now. Initially, you probably would see that staying about the same and probably adding, call it 2% in the convertible bond area. And, it's not a huge, the overall allocation isn't huge in non-core fixed income. I'm not sure I'd want to put a, limit on high yield or a limit on converts. I don't think there would ever be a point where we would, let's say, get out of high yield and be all in converts or vice versa. I think it would always be a split, whether we leaned one direction or another is probably just market dependent.
Okay.
I don't know if that answers your question, Mark, hopefully.
Well, basically, what I'm hearing you say is, you don't know exactly how the split's going to go, and there's not a big enough position in the non-core to really make that much of a difference. And so you need that flexibility within that range. Is that what I'm hearing?
I think
Okay.
that's right. We would want to maintain that flexibility within that range.
Okay.
Yes.
You put it way more succinctly than you did.
You did.
Yeah.
Just run it out there. You're used to that, right?
Another question is, what's the idea behind changing the fixed income benchmark?
So right now, we can only invest in securities that have a maturity out to 12 years.
Okay.
So we're in that shorter end of the curve. So we can't invest out into the, say 20 and 30-year bonds. That hasn't been a very attractive place to be in recent times. And that was, we're happy that we didn't make that change sooner, because if you look at last year's numbers, I'll get it wrong, but the aggregate lost something like 13-14%, and the intermediate lost 8-9. So neither one is good, obviously, but one's less than the other. So it was good to be shorter duration. But now that interest rates have gone back up in the long end, I think it makes a lot more sense for them to lock in some of that yield.
Okay, so if you are tending to possibly go longer on the fixed income, again, going back to Jack's question, you had that discussion with State Fund about that?
Yeah, absolutely.
Okay.
And we did an analysis of the liabilities and, you know, the payout that they typically have. And I mean, as you well know, Mark, there's a lot of front end intermediate payout to claims, but there is that long tail.
Yep.
For certain claims, and that actually, if you looked at sort of how that works with them, John Carpenter actually had done some analysis there, and it matches up better. You know, the cash flow stream that we would get off of being in the aggregate matches up better than it does in the intermediate. So that actually makes quite a bit of sense, and it's more consistent with what peers are doing. Most of the peers benchmark themselves against the aggregate. There are a few that still were using the intermediate, but you know, honestly, as long as I've been here, it's always been the intermediate ag, and I think it's probably just somewhat of a legacy, you know, way that it was set up originally, or maybe that was more standard at that point in time, but I think most have shifted to the aggregate over time at any rate.
Okay, all right, thanks.
Just for the new board members, we spend a lot of time on these policies because it's one of the main ways the board can exercise our control and make sure the staff, even though they've got tremendous amount of delegated authority, that we still have the control and understand what they're doing. So it's important that board members understand our policies and make sure we feel comfortable with some of the limits that we put on staff. And so, is there any other questions that anybody may have for this? Hearing none, I see Becky there, and I know she doesn't want to take a nap. So Becky, just on a high level, with what we're working with State Fund, I know RVK has helped these guys. Do you have any comments, or do you think that we're doing the right things on these?
No, we definitely do feel like we're doing the right thing. And it was nice to see some of the modeling that Greg was able to produce to look at the impact on the health of the, you know, the risk-based capital measure that John had mentioned. So we definitely are supportive of this diversification, and it's similar to the types of diversifying recommendations we're giving to other similar insurance clients. So we are comfortable, and the benchmark changes we're also comfortable with.
Okay, thank you.
Mhm.
So John, do you want us just to do a motion to approve policy number 40-7, or do you want to do them all together as a group, or how would you like to?
Oh, I think you can do them all together as a group, in my opinion, unless you want to separate it out for some reason.
Sometimes when there's big changes on some things that we might want to do some extra explanations or discussions, we might want to break them out, but I feel comfortable doing all as a group. And so before we get to that, is there anything else on some of those individual policy statements that you'd want to comment on? Or, you know, I'd want to make sure John Ramasco has some comments.
Maybe for the new board members' benefit. So John Ramasco is the primary liaison, I guess, if you will, for the State Fund relationship. It's always the fixed income team with all of our separate accounts. They have, you know, big investment grade fixed income allocations. And so the fixed income team has always been responsible for all the separate account relationships, but State Fund is a particularly big one. And so, you know, he is on that as well as myself, and we go report to their board at least once a year. And we've set up quarterly meetings now with Holly and her staff as well. So anything you would add, John, in terms of the State Fund relationship?
No, I think it's all going well, and it's an important relationship for us, and we dedicate a lot of time and effort to it, and certainly supportive of the policy statement as it's written. Hope to have an opportunity to lock in some higher yields for a longer time frame.
Okay, any other questions? If not, I'd entertain a motion to approve the policy changes to include all the sub-policies with this in addition to 40-0.7.
I'll move it.
Okay, Mark moved. Is there a second?
I will second it. Jack.
Okay, so now you're to be blamed for anything that goes wrong. at state. Thank you. Any additional comments or questions? If not, I'll call for a vote. All in favor of the policy changes and updates, say aye.
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 Is there anybody that's opposed to these policy changes? Same sign. Hearing none, the policies are approved. Thank you.
Thank you, Mr.
So
Chairman.
Dan, we're moving right ahead because you got such an efficient chairman.
I tell you what, you're right on it. So, Mr. Chairman, I don't know, we are an hour and a half ahead of schedule. Would you like me to check with the investment directors to see if we can get the 2 reports for tomorrow done today? They're not action items, so they do not need a vote and therefore don't need the same notice requirements. What's your pleasure? What's your pleasure?
I think, you know, these are long days, but with us being at home and Zoom and not driving and things, I'd like to get as much done today as possible. So I'll just check with the rest of board members. Is that okay with you guys?
Yes.
Yeah, sounds good.
Okay, I'll line the rest of our crew up and get them ready to go while John and Polly discuss cash management of state monies with.
Okay. So John and Polly, welcome. We look forward to your report, and I'll turn it over to you guys and you can do your report as you'd like.
Perfect. Thank you, Mr. Chair and members of the board. My name is John Carpenter. I am the Accounting Bureau Manager, presenting today with Polly Botine, who's our Associate Financial Manager. So just for the new board members, we call them deep dives. So basically, as part of the continuing education, we pick a topic or 2 every board meeting and give you an opportunity to kind of hear in depth what the Board of Investments does for different clients, different asset classes, that sort of thing. So today we're going to talk about cash management of state monies, plenty of money at the state, as I'm sure you're well aware. So we'll go ahead and start with Polly. Let me pull up our presentation, and Polly, go ahead when you're ready.
Thanks, John. Good afternoon, Mr. Chairman and members of the board. Welcome to the newer members. Let's start by going to slide 2. We'll start with a little bit of institutional background. The Board of Investments' original and primary mission is to prudently manage the Unified Investment Program. You've been hearing that a lot today, but that's the UIP. We call it the UIP also. UIP was created by the Montana Constitution. It consists of the state's retirement funds, trust funds, short-term investment pool, and other funds. The net asset value of the UIP at fiscal year end 2022 was $25.4 billion. So in order to process all of the activity for the UIP, the accounting department initiates tens of thousands of journal lines on the state's accounting system, and the transactions total in the billions of dollars. If you could move to slide 3. Oh, you did, John. Thank you. In 1973, the board created this short-term investment pool, or STIP, to allow participants access to a highly liquid investment vehicle. State agencies and local governments are allowed to participate in STIP. It might be helpful to think of STIP in terms of its 2 main components. STIP is made up of the investments held and all of the activity that goes along with that. For example, the purchase and sales of securities and related income and expenses. On the other side, there are the STIP participants and all of the activity that goes along with that. That entails processing the STIP participant daily transactions and distributing net income to the participants. We could go to slide 4. In order to become a participant, there are agreement forms that need to be completed and submitted to the accounting department of the board. Once the appropriate forms are submitted, participants can access their accounts through a web portal available on our website. STIP participant transactions are fixed at $1, and STIP transactions initiated through the web portal by the daily 2 o'clock deadline will be charged or credited on the following business day. So state agency activity is recorded on the state's accounting system, whereas local government activity is processed through their designated bank via ACH. On the first business day of the month, investment earnings are distributed to participants for the prior month, and participants can elect to receive their earnings, or the earnings can be reinvested to their STIP accounts. Oh, thanks, John. You went to slide 3. STIP is an important component considered by board investment staff when managing the state's cash, because a large portion of the state agencies use STIP as an alternative to holding cash. So the main players in the management of the state's cash are State Street Bank, which is our custodial bank, where all of the investments of the board are held. Of course, the Board of Investments, and US Bank, which is the bank's depository bank, where the state's cash deposits are held. And the Department of Administration, because they are the primary owner of the depository bank relationship. The diagram on this page, in the upper middle portion, you'll see inflows coming into the various state agencies and local governments. The slide shows revenues, but of course there are expenditures that need to be made as well. So based on this activity, the STIP participants will be making decisions to either buy or sell cash for their particular cash needs. The left side of the diagram shows the state agency participants. Their activity is flowing through the state's depository bank. This is because the state's depository bank is basically the state's checkbook. And that is where the revenue and expenditure for agencies are flowing into and out of. The right side of the diagram shows the local government activity flowing through the custodial bank, and that's because the custodial bank is the one initiating the ACH activity for the local government STIP buys and sells. The bottom middle of the diagram shows the Board of Investments. So the investment staff are instructing movement between the two banks, the depository and custodial bank, based on inflows and outflows that happen at the depository bank, STIP participant activity, and investment activity on behalf of STIP, maybe maturities or income coming in. And they are also trying to maintain a target balance at the depository bank. So taking all of this into consideration, fixed income team or the investment team at the board determine what amount of STIP investment buys are going to be made for the day. And once that is finalized, there's a net cash settlement that takes place between the custodial and depository bank. So hopefully this gives you a little bit of insight into what is happening daily at the board to actively manage the state's cash. There's a lot of moving pieces and coordination between parties to get this done, and it's all done before 10 a.m. every day. So a lot of activity. So we just covered a lot of material. So you may have some questions when we're done with our presentation.
So I'll go ahead and cover just kind of what we do with the treasurer's fund. So when you think of treasurer's fund, it's basically the state general fund and any state agencies that are not allowed by statute to own their own STIP account. As of yesterday, the treasurer's fund had about $3.8 billion. Total STIP is about 8.4 billion. So the treasurer's fund about 45% of the total STIP balance that we hold. As you can see from the diagram, 93% of the money we do hold in STIP. By policy, which we changed in November of 21, the treasurer's funds also allowed to buy US treasuries up to 3 years, agency discount notes, and the trust funds investment pool. They're now allowed to be an investor in, thanks to the policy change the board approved. As far as restraints, so when we're thinking of the treasurer's fund, obviously liquidity is important. We don't know from day to day the cash needs of the state. So that's why we keep a lot of it in STIP. This kind of goes into detail. The trust funds investment pool is a longer term perspective. And so we want to make sure that we don't leave the cash or leave the state strapped for cash at any point. So again, about 7% of the portfolio is in longer securities. Policy allows us, I don't want to do too much math, but basically the cap is about 350 million out of that 3.8 billion that can be invested in longer securities. The idea on the policy change was the state had a large amount of cash. It never seemed to dip below a certain level. So why not earn 3% if, instead of the 1% on those funds? So Dan worked with the Department of Administration. They signed off on it. And so we've been able to invest in trust funds investment pool since November. Here's just a quick graph. You can see trust funds, or the treasurer's fund, used to hang out, right around 1.5 billion. We can identify the three big jumps. If you recall 2020, which some of us do, some of us don't, by choice, that $1 billion jump is CARES Act money that came into the state. And then in 21 and 22 in May, we got 500 million each of ARPA funds. That was just a supplement to increased property taxes, tax revenue, which came into the state. Again, local government, actually local government, not part of this. So income taxes, property taxes, and then just earnings and management of the state budget. So there's kind of the trend there. Go to the next slide. So again, 93% of it is in STIP. The focus, liquidity, or safety first, liquidity second, and income third. Preserving principal, as Polly said, dollar in, dollar out. We do have a reserve account in the event we were to take a loss on a security, but that is there more as a safety measure. We've not had to dip into that at any point recently, anyway. We talked about the number of participants. So there's currently 536 active accounts in STIP. 350 of those roughly belong to state entities, and then 180 are local governments. And again, this diagram looks familiar. So you can see the increase since 2020. We eclipsed the $4 million mark, or $4 billion mark, and then right before year end, it eclipsed 8 billion with a current balance of 8.4. Again, this is monies held at both at the state and local governments, which the people at the Capitol are trying to spend down as we speak. Just a quick slide on investment yields. You see the trajectory here. Currently, STIP is yielding about 4.3%. We don't anticipate this to keep going, but again, not our decision where the Federal Reserve sets interest rates. STIP has been a beneficiary of increased rates. You heard Putnam talk about, how longer term portfolios were negatively impacted. STIP has actually been a beneficiary, moving rates from close to zero to, again, the 4.3%, which has also benefited the state with the larger balance. Just talk briefly, again, on the short-term investment pool. It's shorter maturities out to 2 years for floating rate notes. Most of it is commercial paper, 90 days and in, money market funds. Again, daily liquidity is an important thing. We don't know from day to day the cash needs. So again, Polly talked about the communication piece. We do get an email from the Department of Administration, and then we have some, that's on a daily basis. And then we do have regular cash flows that we know about. We know pensions are going out the last day of the month. We know when payments are going out to the schools, benefit payments, and then state payroll is another big one there. So when we talk about daily liquidity of 10% at year end, that was roughly $980 million of daily liquidity that we had available should a participant ask for funds, whether that's state or local government. So definitely managed to that. Trust funds investment pool, again, it's got its own policy statement, but the idea is a longer horizon. Historically, it's yielded just over 3%, whereas STIP has historically yielded about 1%. But they're pretty close right now, but we don't anticipate that lasting forever. So again, it's a vehicle. If the state has monies it doesn't need to access for that 3 to 5 year time range, we do put some of that in trust funds investment pool and benefit from the additional yield there. So just to wrap up, you can see from Polly's diagram, there are several moving parts as it relates to managing state monies on a daily basis. From the fixed income side to operations, getting those trades sent, and accounting, making sure that we record those appropriately. Again, our responsibility of meeting the state's cash needs through generating investment income, as well as taking a prudent amount of risk, is a critical function of what we do. Couldn't do it without the hard work of the fixed income team, operations, and again, accounting. You see the volume, the 3,500 transactions was just in the STIP. So when we take into account trust funds, private managers, again, there's thousands and thousands of transactions just in a single year. And we keep track of all 26 billion pennies. So with that, we will happy to take questions.
So one question I have is, as you know, I'm always concerned about risk. From a high level board point of view, what is the main risk in these policy and procedures that you've talked about? Is it just to keep track of all the transactions, or would you talk to me a little bit about the risks that the board should look at when we're looking at this?
Yeah, certainly. I think you talked on the investment policy side as far as managing risk there. On the accounting side, and you might recognize me from the investment side. A couple months ago, we decided there were too many Johns on that side of the building, so I moved over to accounting, which is a good, I guess, a good perspective to see how accounting handles it on the other side. I can tell you there are tons and tons of reconciliations that go on a daily basis. So for every check that we have, there's a double check where if something doesn't look right on one side, we're going to catch it on the other. So Julie's also an important part of that. Our SOC audits, making sure we have the controls in place. So I would say, there's always a risk when you're trying to reconcile 26 billion, but so far so good.
Other questions? Hearing none. Thank you, John and Polly. You must have done a good job that we didn't have to get too confused. The one thing I do want to mention to, especially the new board members, if something comes up, the staff is available to answer individual questions if you have them. Okay.
Absolutely. All right.
Anything else for cash management, Polly or you?
No,
Okay, well,
We're
thank
good.
you.
Thank you, Mr. Chair.
thanks.
Thank you.
Okay. So on our agenda, we have a little break, but since we're pretty flexible today, and we haven't been going at this too long yet, I think we'll have the break in a little bit, but we'll continue on if that's all right with you, Dan.
You bet. Doug's ready to go. He's raring. He's
And so Doug is, you know, usually in the mornings at Loan Committee. We'll see if he's awake in the afternoons. And so,
I'm
so
awake.
Doug, I'll turn it over to you.
First of all, thank you, Mr. Chairman. Can you hear me?
Yes.
Yep. Great, great. So good afternoon, Mr. Chairman and members of the board. So I'll go over the commercial and residential loan portfolios memo. So the participation loan program has an outstanding balance as of the end of the year of a little over 93 million, and that represents 41 loans with a yield of 2.51%. There's currently 6 loan reservations that total a little over 18.7 million, and 4 loans committed that total a little over 23.4 million. There's no past due loans in the participation loan portfolio. Under the infrastructure loan program, reflected an outstanding balance at the end of the year of a little over 10.5 million. And that's 8 loans with a yield of 4.07%. There is 1 loan reservation for a little over 2.7 million, and we have no past due loans in that portfolio. The intermediary relending program has an outstanding balance at the end of the year of a little under 5 million and represents 38 loans, and the yield on that is 2%, which is a statutorily rate. There's 1 loan committed for 500,000 and no past due loans. In science and tech, the end of the year balance was a little over 7.7 million. It's 3 loans and the return is 2.75, and none of those are past due. And then the Montana Facility Finance Authority has an outstanding balance at the end of the year of a little over 12 million, and that's 16 loans with a yield at 2.53%, and none of those are past due. The Veterans Home Loan Mortgage portfolio has an outstanding balance as of January 26th of roughly 48.7 million. That's 277 loans, and the yield in that portfolio is 1.8%. There's 4 reservations that a little over 1.1 million. The projected yield on those 4 loans is 4.17%. And then there's 2 loans that are over 90 days past due, roughly a little over $430,000, which is 0.88% of the portfolio. The multifamily Coal Trust Homes program balance as of January 23rd is a little over 9.6 million. That's 6 loans, and the yield on that is 2.34%. There are 2 reservations that total a little over 4.5 million, and there's no past due loans. And then the residential loan portfolio had a balance at the end of the year of a little over 1.5 million. That's 54 loans. The yield on there is 6.32%. No outstanding reservations, and there's 2 loans that are past due over 90 days. And then the final item is the down payment assistance program. Outstanding balance as of January 26th, a little over 9.2 million. And that's 26 loans. There's currently 59 loan reservations that total a little over 44.8 million. And then there's 36 loans committed that total a little over 21 million. And 8 loans have been withdrawn for a total of a little over 3.4 million. So with that, happy to answer any questions that you might have.
I have a couple of questions, Mr. Chairman. For
Yes,
Mr.
go ahead,
Hill.
please.
I noticed that on 2 of those, let's see, the Veterans Home Loan Mortgage, you had 2 of them 90 days past due, and then there's another one, must have been, another one had some that were, oh
The
yeah, the residential loan
residential.
portfolio, yeah. What is the procedure there for the board's procedure for foreclosing those if they don't get back on track?
So, good question. The Montana Housing or the Montana Board of Housing services all of the residential loans for the Board of Investment. So if a loan goes into default, the servicing department at the Board of Housing will process the foreclosure. And if it gets to foreclosure and the property is actually foreclosed on, then they will file the claim with the federal guarantee agency that's guaranteeing the loan. So in the case of the residential loan portfolio, the 2 loans that are past due have FHA guarantees on them. And so the Board of Investments is at no risk essentially of losing any of the principal on those loans. And the same goes with the Veterans Home Loan Program, is those loans are either guaranteed through the Veterans Administration or the Federal Housing Administration. So they have guarantees on them so that the risk of losses would be minimal, with any of those 2 programs.
So the guarantors would ultimately repay those loans to the Board of Investment.
That's correct.
Okay, thank you.
You're welcome.
Other questions? If not, Doug, you're in touch with bankers all the time.
I think
Could you
Mark's
just
got his
give us
hands
a-
raised there.
Oh, okay, go ahead.
Sorry.
Thank you.
I'm sorry, Mr. Chairman. On the multifamily, you have 2 loans that are reserved for $4.5 million, I believe. Yeah.
Yeah.
Now the current yield is 2.34. What's the yield on these 2 reservations? Or can you explain that to me?
So the 2 reservations, I'm not sure right offhand what the interest rate is on those 2 loans, but I can get that and get back to you, Mark. But the Board of Housing administers this program. They set the rates with the guidance from the statutes. And so the rates on these, I think all of the loans, they've got $15 million allotted to them for this program. So the rates have been established for all of the loans that either are currently booked or funded and reserved.
Okay. All right. That's good enough. Thanks.
Jack, if I could jump in here real quick,
Sure.
I've mentioned this to the board previously that I am concerned. So all of these show up within Coal Trust performance on our side, except for down payment assistance. The rest of them are loans we either directly make through the participation loan program, infrastructure loan program, or the IRP program. Science and tech we inherited from 1989. Facility finance is administered and called out separately. Veterans Home Loan is administered by the Board of Housing separately. Multifamily Coal Trust is administered separately. So we don't control the yield on those loans, but we get blamed for a lack of yield on those loans by anyone who happens to look at our performance. So what I'm going to be working on with the accounting team and Julie as the controller is how do we basically create some sub-accounts within the perm coal or within the coal trust, showing the yield that we're able to get on those loans that we administer and don't have some sort of legislatively artificially low rate versus those pools that the legislature has created. So for instance, the IRP program, we can only get 2% on that by statute. But the lender, the local economic development agency, the last one I saw was they did 8%, and they get to keep the spread between 8 and 2. That's a legislative policy, not ours. So moving forward, you'll see these hopefully broken out in our performance, where you'll see legislative performance, BOI performance distinct, so that when we get the questions, why isn't yield and trust fund higher, we'll be able to point to the 2 separate sub-accounts and say, because you said so. So just a heads up on this, that'll be coming in the next several months.
Good. Any questions? Doug, I just always like to hear what you see in the economic environment in your discussion with bankers.
Sure, Mr. Chairman. So obviously, the increase in the interest rates is having an impact on the amount of activity that the lenders are seeing. Rates have gone up probably 4 to 5% from where we were seeing them earlier. And so it is impacting the number of loans that the lenders are making, but at the same time, they're still making them too, because I can see from the down payment assistance program, the rates that the lenders are charging. And so we're seeing an increase in the interest rates, but at the same point, with the programs that we have, especially the down payment assistance program, when the borrower can get, a really good interest rate on our 30% plus no payments until January of 2027, they're still going through with the transactions, even though the lenders' rates, are increasing.
Thank you. Any other questions for Doug? Hearing none, thank you.
Yeah, thank you.
So now we've turned this over to Louise. We already met her earlier today, but she's got another presentation for us. So Louise, are you ready?
I believe I am. Thank you, Mr. Chairman. So in audit committee, I believe member Barry had a question regarding public disclosure to EMMA, that's electronic municipal market access. Do you remember what that question was, member Barry?
I remember asking it, but I don't recall the exact.
Okay. All right. Well, how about I'll just say a few words about public disclosure. We used to have to do that for the InterCap program when we had those publicly remarketed tax exempt bonds, but those are no longer required for InterCap. However, the Board of Investments does provide an annual report to EMMA for its credit enhancement of the Montana Facility Finance Authority. So we provide a list of bonds that the BOI credit enhances, along with the links to our annual report and our audited financial statements. So that's only required once a year. For InterCap, we used to have to do quarterly reports, but with this new program that we're doing, we don't have to do that anymore. I hope that answers your question.
Yeah, it was related to when we talked about the early issuance of the financial statements, and it used to be it's related to the Montana Facility Finance Authority, but it used to be part of the bond program. So that was a question. So that answers the question.
Okay, great. I'm glad. All right, so there's just a couple of things here for InterCap. We have our activity summary and our staff approved loans, but you also know that we just recently have gone through our new rate reset. So let's talk about that a little bit. The board adopted Resolution 249 in November 2021, you'll recall. So how did we do with that? That bond matures every February 20th. So to go along with the requirements of the Section 4 in that resolution, the issuer and the purchaser must agree to extend that bond for another year on or before February 1st. So we did that January 31st. The bond interest payments were due August 20th and February 20th. And we paid that the first installment in August on the 11th and February on the 17th. So we were ahead on those. It also, when it comes to resetting that bond rate, so the bond rate must be midpoint yield of US T-bill with maturity close to 365 days plus a 10 bips or 10 basis points on February 14th. So how did that translate out when we had that determined? Midpoint this year was 4.969%. So we added we added 10 basis points to that. So the bond rate this year is 5.069%. So that's valid between February 21st of this year to February 20th of 2024. So using a snapshot of the program considering loans with and without auto pay, the borrower loan rate is 5.75% for auto pay, and it will be 6% for those without. So that extra 25 basis points helps us out with the extra effort that it takes with processing checks that come in, wires that come in, ACHs, instead of the BOI accounting staff initiating an ACH once a year. So that helps us cover those expenses. So with that,
Louise, can I ask? So
Sure.
one more time, the 4.969% is a midpoint yield of what again?
of a US T-bill, Treasury bill.
Okay. At a point in time or over a period of time?
Maturity closest to 365 days, so about a year T-bill.
Okay. Thank you.
You bet. So when considering putting this together, we use a snapshot of the program. So I left enough there, enough room in the spread for all loans to switch to auto pay, you know, fingers crossed that would happen and still cover program expenses. So so there's enough room there. The borrower loan rate is valid between February 16th of this year to February 15th of 2024. Notification of that new rate is on the website. So if you need to direct anyone, we have the new rate out there, and also our rate history is out there. And talking about rate history, the highest this program has ever been is in 1989 for 7.95 was our highest rate. And our lowest rate was 1% 2 years in the running in 13 and 14. And I believe we did put a little money into keeping it down on that second year. So that was our lowest that we've done. So how about we just take a look, we'll reference back to the activity summary, and we'll take a look at that bond series 2022 box where you see that outstanding there. So the interest payable to STIP this year will be about 3.5 million based on that bonds outstanding. And you'll remember from adopting that resolution that the bond outstanding is dependent on the borrower demand, and it may fluctuate. So we have the ability to either advance on that loan, which you'll see available for drawdown, that number, that 51 million. That's how much is available to the program if borrowers need it. If we don't, we can actually redeem that and lower that 68 million. So that may fluctuate a little bit in what's expected for a bond interest payment. So last year, the amount was static with the repayments coming in being sufficient to fund the loans going out. So that's why that amount there, the 68.7 that we have for the bonds, that stayed the same the entire year. So there's roughly about 50% of the borrowers with intercap loans outstanding are also STIP participants benefiting from the bond yield. So there's a good thing happening there, having that bond sitting in STIP. Also, the program liquid is no longer yield restricted to the bond rate as the old tax exempt bonds were, and is invested in STIP. So when we're putting together that loan rate, that spread, the estimated earnings from that is also included to further reduce the spread applied to the bond rate to arrive at that borrower loan rate. Coming back to the activity summary, the commitments and fundings, they'll probably come up a little bit with just right now we have about 2.8, about 2.8 on both sides, commitments and fundings to add to that amount as of February. Usually comes up a little bit in spring. There's a little spike right before spring on both of those. And I did predict, because of like we discussed before with the ARPA money out there, that will probably be maybe under 20 million on both sides this year. As you can compare that graph on the far right there of what we've had in the past 5 years. So I'm happy to answer any questions on the activity summary or the staff approved loans if anybody has any.
Questions? You must have answered them all in the beginning, so thank you, Louise. Good job.
Great, thank you.
Okay.
Thank you.
So, I guess that completes tab 6, the bond report. I see Becky here. I appreciate you being flexible. If it was Jim here, I'd be a little more worried, but anyway, so the next report we're going to go is we're going into the next day. We'll take a little break after Becky's report, but so you have all the time you need to do your report. But for the new board members, could you talk a little bit about RVK just to get us started, and then go into your report?
Absolutely. And I think Savannah is going to share the screen there so we can start with section 1, Savannah, while I'm actually introducing RVK just a bit. So my name is Becky Gratzinger. I'm the CEO of RVK, and with me servicing you on this account is a big service team, including Jim Voitko, our president. And we also have a number of folks that are on that team, including Paige, which you will meet at our next meeting. Blazer, who actually works out of Sun Valley. RVK is actually headquartered in Portland. Although we have offices around the country, including in Boise, and then Paige is operating nearby, plus Chicago and New York. So RVK has had the pleasure of working with the Bureau going back to, I believe, 2006. And it has been a real honor to see how the program has grown, and diversification has been built over time. Performance here has been excellent, as you will see, even in a tough year like 2022. You'll see that relative to other plans and relative to your benchmarks, you've done quite well. So RVK is a little different than some of the competition out there that we run into, in that we own ourselves and have since the very beginning. And we operate in a no conflict of interest model, which means that we aren't a consultant that manages money. We have stayed away from that and believe that can be a conflict. We'd like to give unbiased investment advice to you. So we like to say we sit on the same side of the table as you are, and our only compensation comes through the retainer and project fees that our clients pay us. We consult to about 3 trillion in assets, and that's grown a lot from when I started in '94. And we have a couple hundred clients and about 450 or so portfolios that we follow, which are individual plans. Like the Bureau has many plans in our relationship that we'll talk about in the performance reports, and many other clients have multiple pools of money that we consult to. So with that, I'm the CEO, who also is a very active senior consultant. So I don't just run the business along with Jim and our board and shareholders and managers, but each of us are fully engaged senior consultants. So please stop me at any point if you have questions on the firm. I'd like to invite all the new board members, if you have opportunity to come see us in Portland, we'd love to do some education or even come early to your meetings and provide some time with that as well. So is that, Jack, is that kind of what you had in mind before we jumped into talking about the markets and performance?
Yes, that's exactly right. We have a contract with these guys that I think we just reviewed or renewed a year or so ago. And they've been, they're sort of a check. So we have outside sources looking at our figures, and they do have some real expertise, and they've really value added to this organization over time. So thank you, Becky.
Thank you so much. Well, you're going to see a couple of our primary products that we provide to the Bureau every quarter in the course of this presentation today. The one that is up on the screen, hopefully that everyone can see, is, if you will, kind of the Cliff Notes version of performance, or the condensed version of performance. So I'll go over just a couple of items in that report, and then we'll refer you to what we'll call section 2, which is the bigger report that Savannah can share in just a couple of minutes. But there's a couple of graphs that I thought were helpful in this report. If we move past the cover page and move to page 4 of this report, I thought this was a nice summary visually of what we saw at the end of 2022. As you know, 2022 was a very unusual year in that stocks went down because interest rates were going up, again, related to the Fed's fight to help bring down inflation. And the equity markets went down at the same time. And we actually looked at this historically. It was one of the worst periods for a simultaneous correction in the bond and the stock markets. And those are the key investment components for a lot of institutional portfolios like state pension plans. So it was a very difficult year. However, we actually ended on a little better note, as you see in the chart at the bottom of this page. The information in green is the quarter-to-date returns, and the information in blue are the one-year returns. So for every asset class that you see here, from US equities shown by the first 2 sets of bars to international equities shown by the next 3, and then looking at the bond market through the Bloomberg Barclays aggregate, cash in the T-bills information, REITs, which are publicly traded real estate securities, and then finally commodities. With the exception of commodities and cash, everything else had a very negative 2022, but a positive quarter. So it was a nice way to end the year, in that investor sentiment was getting a little bit more comfortable with the Fed being further along in their attempt to fight inflation through raising interest rates. And the economy has continued to be somewhat resilient, as evidenced in the employment market. As you've all seen, unemployment has remained incredibly low. In fact, today's unemployment levels are 3.4, which is historically low. So as the Fed has done their work by rapidly raising interest rates, although slowing down in the individual interest rate increases they've implemented, we did see a lot more optimism from investors kind of across the board. And there was also news on the China front, because, as you know, China had their zero tolerance policy with regard to COVID that was creating supply chain issues and concern just about the direction of that economy. And it has a large impact on the supply chain globally. Plus, you know, obviously the war in Russia and Ukraine continues to go on. But it seemed like there were more factors that were feeling a bit more positive, which really helped a number of those markets do better in the fourth quarter. Now, just speaking to what did well in 2022, there were not many asset classes that did well. In fact, commodities happened to be one, buoyed by supply chain issues and the price of energy that went up during the year. We did see some other positive markets, such as real estate, which I'll talk about in our longer report, but there were very few places to hide in 2022. If you look at the next page, we've got another chart that I thought was kind of helpful in describing a couple of major considerations and market indications as we look at how the year progressed compared to where some of these measures were a couple of years ago. So if you look at this chart called Shifting Market Fundamentals, you can see at the top the blue line. The blue line is actually the price to earnings ratio of global stocks. So that is a measure for how expensive equities are relative to history that goes back to 18. And one thing you can notice as you follow the blue line along is that it grew quite a bit between 18 and then after we moved out of the pandemic era, we did see a correction during the pandemic. But as we hit 2022, global equities became cheaper. And that's another way of saying their prices were falling. And that was very painful to investors. If we look at what was happening with the yellow line, that is the US CPI year over year. And so this is this annual growth rate of inflation that we're watching so carefully right now, as you know, and the Fed is too. And if you just look at where that was trending, it really was incredible. Now, keep in mind your axis that you're looking to for the actual numbers is on the right-hand side, whereas the blue line is on the left side. So if you're looking at the actual levels of CPI, you can see that horrible period in the middle of 2022 around June, where we saw that number peak above 9% for the rate of inflation. And that's headline inflation. So we did see, again, as the markets were reacting to this inflationary environment. And keep in mind, we started 2022 with rates of inflation at about 7%. It's just that it kept getting worse. And as we look at where we ended 2022, it's more in the 6.5% range, and it's about 6.4% right now. So obviously, we're a long way from the Fed's desired target of 2%. So a long way to go, but certainly it's nice to come off those peaks. Now, the other point on this chart is what happened with interest rates, with the yield on Treasury securities. And you can see how we were, if you look at the yield, again, we're using the right-hand axis for this comparison. If you look at where the Treasury yield was, and we could extend this line going back a few more years, just look how low it was. You had very low interest payments for holding a 10-year security, a 10-year Treasury for a number of years. And then all of a sudden, we wake up in 2022, and with the Fed's actions, we see that the yields were around 4%, a little under 4% as we ended the year. So a lot of dynamics here, a lot of interrelationships here between these three measures, but it's a nice way to kind of summarize some of the major items that were affecting the markets. Just to point out a couple of more pieces of information that's in this particular portion of the report. At the bottom of the same page, you see some market indications as well as yield information here for the end of the quarter, and then going back a couple of quarters in 2022, and then looking at the 10-year average. And it really is amazing if you look at the federal funds rate. So this is where the Fed is active. Look where it was at the end of the year, and they're still not done yet, as you know, 4.3%. The 10-year average for the federal funds rate is 0.78. So a dramatic increase in the now going forward attractiveness of fixed income from the ability to harvest that yield. And you can see how that federal funds rate progressed through the year as the Fed did a number of 0.75% or 75 basis point interest rate hikes. So again, as we look forward, we're expecting a couple more this year, 2 to 3. We'll see what the size of those increases are. It will be likely very heavily influenced by the data as they've messaged. And the markets, if you look at the equity markets and the responses to the release of the Fed minutes today, they seemed a bit troubled and slightly negative because the Fed was still messaging they're not done yet. They're still going to raise interest rates.
Betsy, can I ask a question?
Sure.
Okay, so what are the PE ratios running right now on average?
We've actually got a couple of indications of where they are. And let me show you a little further back in this report, and I'll find the page for Savannah to move to. Let's move to page 13. This is the price to earnings ratio on the bottom left section of this page. This is the price to earnings ratio for different parts of the US equity markets relative to the history for that kind of investing. So if you look at the US large cap equity number, that's the second column from the left on the bottom of page 13, you can see that the price to earnings ratio at the end of the year was, somewhere around 18 to 19. But you can see where it has been since 1995 on the low end from just below 15 all the way up to the high 20s if you look at the history since 1995. So that's where they are today. But if we were to fast backwards in time, in 2021, you would have seen that blue diamond much closer to the top quartile. And very expensive is the way we would summarize that observation.
So it's still elevated, even though it's come.
Yeah, it has come down, but notice if you look at where the median is for the history since 95, that's where the second and third gray sections of that column meet. And you can see that the blue diamond is just sitting slightly below that.
Okay.
And the answer, you're probably wondering, well, gosh, look at the column to the left. It's all the way to the top. If you look at the entire history of this measure and going back to 1900, stocks are very elevated if you look at that entire history. And the other thing that would be interesting to note, since you let me go down this path, is on page 14, if you look at where those blue diamonds are for international equity, look how different a story it is with the exception of growth international equities. Generally, international equities are not as pricey as US equities.
Right, okay, thank you.
Oh, absolutely. The rest of the report has more economic indicators, some text summary of the year and what was driving it. We've hit a lot of these points, I think, just in the discussion thus far. And so, Savannah, unless we have more questions on this report, I'll actually turn us to what we call section 2, which is the performance report. So in this report, this is where you get more information for the newer trustees, board members. We have an even longer version of this with even more statistics, but this is the package that we put together every quarter that we hope will help you understand what's going on in the portfolios. So again, please stop me as you have any questions. But Savannah, if you could move to page 4, and thank you so much for driving the presentation. So first, we tend to look at our largest collective pool of assets, which is the retirement plans. And the retirement plans, and I will review all of the assets, including the trust funds, so you get a sense for the whole collection of assets that you're overseeing here. But retirement plans account for about $13.5 billion in assets. And the largest plans are the public employees, teachers, bless you, and the teachers' retirement plans, which together are, as you can see, over 11 billion of this total. The next page actually gives you a sense for the retirement plans are actually constructed of holding the consolidated asset pension pool and then some cash. for liquidity. So you can see the allocation to the cap is about 13.3 billion, and then there are allocations to STIP that each one of the retirement plans holds, and you can see that detail in the middle section of the top portion of this page. Performance on page 6 for the retirement plans is outlined, and you can see there's a lot of similarity between the returns of the pension plans, again, because their structure is primarily consisting of that consolidated pension pool that's managed as one pool. And so when you look at this detail, under the quarter to date column, that is the last quarter of the year. Fiscal year to date, as you know, is 6 months as of the end of the year. We start with July 1 and run through the end of the year. And then of course, the calendar year is the full 2022 results. To the right of that are longer periods of time of 3, 5, 7, and 10 years ending in December 2022. And then we've got 20 years even as well on this chart. And then individual calendar years that follow. And you get to the right-hand side of the page and it gives you since inception numbers that go back to 1994. So what we typically do in these reviews is to take a look at what has happened at this point in the fiscal year. We're look at the most recently completed quarter, which is going to be that fourth quarter of the calendar year. You had a return in the public employees plan, which I'll use for illustration for how the retirement plans did generally, had a return of almost 5%, which is really encouraging, a really nice way to turn around some of the patterns that we saw of 2022. When you look at how that translated into the fiscal year to date, that was a return of 1.5% because we are picking up the more difficult quarter that we had ending in September. And then we have 2022, which you can see here was a loss of about 8.48%. Now, just if you make just a mental note of those numbers, let me just give you a little bit of information for what has happened in some of the general markets in 2023 thus far. It's very early in the year, as we all know. There's a lot happening with the Fed being very active. But the S&P 500 through the close of business yesterday is up 4.4, and the international markets, so the non-US markets, are up about 6.4%. And the bond market, as described or captured by the aggregate index, is up about 0.2%. And high yield bonds, another component of our portfolio, are up about 1.3. So obviously adding some more black ink to the returns for our fiscal year to date, which is welcome. And now a couple more pieces of information on this page that I want to call your attention to, going back to the public employee retirement plan, is we compared that performance to a benchmark that's blended to look like the way you invest in the public employees plan, but it's using market indexes to represent the various markets that the retirement plan is exposed to. And you can see the difference column. So when you see the red numbers, those are periods when we underperformed a bit, but you'll see the only red numbers on this page for that difference row for PERS is in the quarter and fiscal year to date. And for the calendar year to date, or calendar year 2022, and all the way through that 10-year period of time, we don't have this benchmark going back 20 years, but through the 10 years that we have it, PERS has outperformed its index. So it's doing a better job than if you were to just index all the investments that you could. And the outperformance for some of these periods is pretty significant. If you look at the 1 year, it's 1.5%. If you look at 3 years, it's 1.7, 1%. As we look at the 5-year period, and then 7 years about 0.4 and then 0.2. So this is one measure of how the plans are doing, is are they doing better than just the broad markets? And another way to measure how they're doing that's less important, because when we compare yourselves to other peers, they have different goals, different assumed rate hurdles, different risk tolerances, different decisions they've made. But just to compare you to plans that are over 5 billion. So they have access to the same kinds of market opportunities that Montana does. You can see what those numbers look like. So you have the return on a gross of fee basis. The previous numbers I gave you were net of fees. To compare you to other plans, we don't have in all cases, so we use a gross of fee comparison. Gross and net are different for the public employees retirement plan. The goal here over time is to be above median and to have as small a number, absolute number of rank as feasible. And when you look here, you can see that your longer term history of 3 years, 5 years, 7 years, 10 years, 20 years is well above median. In fact, generally it's top quartile, and in some cases in the top 10th percentile of other public plans in the case of 10 years. So even though we've had a difficult market in 2022, your plan has held up very well compared to peers and compared to your benchmark. Any questions on this page? Great, be sure and interrupt me. We're going to move forward now a few pages to look at page 9. It's important to understand, if we're going to compare your retirement plans to peers, to understand how relevant is that comparison, how different is the asset allocation, because your selection of how much to have in US equities and non-US equities that we call global ex-US here, and fixed income and global fixed income, that is actually the biggest driver of returns and risk over the long term. In fact, more than 90% of your return will be due to that decision and that structure. So it is very important to not only periodically revisit what that looks like, which was done last year, relative to, we call it an asset allocation study. We look at other possibilities for how you could structure investments. And that's done again on a very regular basis. But that is the biggest driver of risk and return, and not only the biggest driver for Montana, but all institutional investors. So we need to understand, what's our structure look like relative to peers? And you can see that information at the bottom. And to illustrate a couple comparisons here, if you look at US equities, the retirement plans have about 28% in US equities, and yet that is the green diamond in that column. And you can see that it is above median where the second and third gray sections meet. So it's very solidly in the second quartile, meaning you don't have the highest equity exposure of peers, but you have more than the median plan. The median plan actually has compared to your 28. If you look at non-US equities, we call it global ex-US here, you can see a similar kind of observation at 16% versus 14.6% for your peers. So overall, you have a little bit more in equity, adding those two components together than the median plan. Fixed income, you have a pretty similar structure. Looking at US fixed income and global, you can see where those green diamonds are. They're pretty close to that median level. Alternatives is a combination of a lot of strategies here, inclusive of private equity, inclusive in other plans of other asset classes like hedge funds. And you can see that your allocation is pretty close, about 23% versus 24% for the median. Other plans on average do have an allocation to hedge funds, and we don't here. You have other types of diversification in your plan. So that's one of the bigger delineations between yourself and other plans. And real estate, you can see you are in the top quartile of having a higher real estate allocation than the median plan at 8.2. Yours is about 12.7. It just so happened that last year was a terrific year to hold real estate. Actually, it's been a very accretive asset class. Part of your real estate portfolio generates income, which is very helpful for paying benefit payments. But it also tends to do well in inflationary periods because that inflation can be passed on in lease payments. And so that has been very helpful for your plan. And then finally, cash on the right-hand side. So any questions about this page? Terrific. Let's move ahead to page 11. It's important, and Jackie brought this up, looking at risk and return. Risk is very important to keep in mind, not just the return that we're generating over time to pay those benefit payments, but how much return volatility is there when the market's correct? How's our performance look? And this particular chart looks at a couple things in the upper left-hand section of this page. You can see here for 5 years with risk shown horizontally and return vertically. You are again the green diamond, and the benchmark that we use to compare your performance that we reviewed a few pages before. You can see that number one, that green diamond is towards the upper left-hand section of this chart. That's exactly where you'd like to be. This is really saying that relative to your benchmark, you're taking less risk and you've generated more return. That's a great combination. And you may say, well, what is the red hash mark there at cross point? That is actually looking at the median plan that we just compared your structure to and your performance to for a few moments ago. Those are the gray boxes, and that shows you some other funds in the same size category of over 5 billion. And you can see where their risk and return attributes are. So you have beat the median plan in that universe with a little bit less volatility. And again, we like you being in the Northwest quadrant. We always joke because Portland is in the Northwest section of the country. That's not why we like this particular chart, but well, just keep in mind the Northwest quadrant is a great place to be, balancing risk and return, where you're getting more return at a little bit less risk. There are some other risk measures on this page that we can talk about in future reports. But if I were to summarize the relative level of risk that you're taking compared to your benchmark and other plans, and how your risk-adjusted performance looks like, in fact, your Sharpe ratio is one you may be familiar with, and there's a glossary in the back for the newer members that goes over a lot of definitions. And this is a risk-adjusted excess return. You can see here compared to your peers, you're in the 28th percentile, again, near the top, and have a much better attribute in that measure relative to your benchmark. So any questions on that page before we go over the same information for 10 years? Let's go ahead and move to page 12. So this is the same information for page 12. And if you just look at the relative positioning of that green diamond and your benchmark compared to the hash marks, you even have a little bit more outperformance relative to the median plan. And risk is just slightly less. So again, a good trade-off because you're slightly to the left of the median risk level of just under 7%, but relative to your benchmark, significantly better attributes there. All right, we're going to move from focusing on the retirement plans to, on the next page, we actually show you the CAP, the Consolidated Asset Pension Pool, the short-term investment pool that we were speaking to a few moments ago with a little over 8 billion, and then the trust funds investment pool, which is just under 3 billion. So that brings you to a total of about 24.5 billion. If you look on page 14, we actually review the performance of that CAP pool. Again, that's the engine of your retirement plans. And we've already reviewed the total performance of the retirement plan, including any cash balances that they have. in the previous pages, so I won't repeat that, but you can see the performance of the trust fund investment pool, again, much more fixed income oriented than the cap. And the returns here a little better in a tough year in 2022, down about 6.3. Over longer periods of time, a little softer returns in the retirement plans, again, because the majority is invested in fixed income investments, but with some of the additional diversification that we talked about a few moments ago. And then the good news on the short-term investment pool is that as interest rates are going up, the yields in STIP will continue to improve. Whereas just if you look at the last 10 years, the returns on just holding cash were very low. And if you had a need to generate a return of somewhere between 6 and 8%, like most institutional investors do, you couldn't afford to just be in cash. So, any questions at this point? All right, I will speed up a little bit so I can make good use of your time. Let's look on page 15. This is looking at the structure of the consolidated asset pension pool. You've got a sense for how the retirement plans are structured by looking at your comparison versus peers at the beginning of this second report we're going over. This actually gives you the detail of the cap portfolio. If you add together the domestic and international pieces, you have about 45% or so in equities. If you look at the combination of core fixed income and non-core fixed income, that's around 20% of the portfolio. Private investments, so that's looking at private equity and private credit and other similar strategies, about 17%. Real estate, about 13%, 12.7%, and then you have real assets of about 6%. So that is the structure of the cap. Now, if you look at the tools that CAP uses to generate returns, these are the individual asset class returns for near and longer periods. When you look at this information, you can see that we show domestic equity first, and then its index that actually is structured relative to the portfolio. We have primarily index-oriented investments in domestic equity after a history of having active and passive together and more passive and longer history. But as we look at this more modern history, you can see that our performance is very close to the index. And that's been by design, is just looking at the probability that active US equity managers have. It's much more difficult to add additional return above the markets because the markets tend to be very efficient and indexing is very cheap, very inexpensive compared to active management. So when you look at those returns and say, gosh, for the quarter and fiscal year to date and calendar year to date, it's very similar to the custom index. That's by design. Now, when you look at the absolute level of returns in domestic equity for the quarter to date, again, better news than for the fiscal year to date and 2022, with gains of about 7.3. For the fiscal year to date, returns of just under 3%. And for the calendar year to date, the US equity markets lost 19%. Again, just no way to say it differently other than it was a difficult year. International investments actually did a little better in all three measurements here. When you look at the quarter, returns of about 13.8, just under 3% for the fiscal year to date, and losing 17.7 for 2022. Again, no place to hide here either, but again, the performance of domestic and international equity markets can be very different depending on the cycle we're in. There was more similarity here, but just a little bit less of a loss in 2022 and a little stronger end to the year. Fixed income, as John had talked about earlier, it was a tough year for fixed income because interest rates went up, which pushes bond prices down. Again, a direct reflection of the Fed's work and the concern about inflation. When you look at the last quarter, it was in positive territory. As again, I mentioned that some of the sentiment was turning towards a little bit less negative rhetoric coming from the Fed. For the fiscal year to date, in negative territory though, and that is in contrast to your equity investments that we just reviewed above. And for the year, John was remembering right, losses of about 12% for 2022. Now, when you look at the relative performance here, again, there's no issues or concerns. When you look at that difference row, performance that looks in excess of the benchmark we're using. And I didn't mention an international equity also constructive versus the index, just in the shorter term period, a bit of underperformance because of some growth oriented managers in that portfolio, but not significant concerns by any means at this point. Non-core fixed income tends to be more high yield oriented. We did see a good last quarter of the year. Returns actually in those markets better than the equity markets for 6 months for our fiscal year to date, that is half completed. And then for 2022, losses that were actually a little bit less than the core fixed income markets. And again, they have a little higher yields to begin with, which helped in their total return last year. Now, longer term, the performance here versus the benchmark has been some underperformance. We went through a project a couple of years ago to reduce the fees of the managers in this space. But in general, what we tend to find in the non-core fixed income area for the high yield component is when the markets are very productive and default risks and actual defaults in fixed income is less, this tends to be a bit more conservatively run portfolio and not taking the junkiest of the junk bonds that are in the high yield component. That's one thing that certainly has impacted performance. But when we look at what the actual return numbers are compared to core fixed income, you can see how helpful that non-core component has been. When we look at the last 10 years, it's actually generated a return of 3.5%, whereas core fixed income has generated a 1.21% rate of return. Real assets is next. A very big help last year between real assets and real estate in 2022. Positive numbers in the black here, and very, very welcome. So real assets up about 15.9, 12% for real estate. Welcome. We are starting to see real estate prices start to be written down a bit. So that is something to note there. And then finally, we're still on page 16. When you look at the cash and pensions, you can see positive returns there. Private investments, again, these numbers are going to always be a mismatch with the private investment custom index because we're trying to compare the performance of investments that are not marked to market as frequently, and we're comparing it to the public markets. So there's always going to be some mismatch there, especially in shorter periods of time, but versus longer periods of time. As you look to the right on this page, you can see for 3, 5, 7, and 10 years, some really nice actual numbers. 3 years, for example, a return of 18% nearly, and performance above our custom index. So that was very welcome to see. So getting very close to the end of my remarks here, I just wanted to point out a couple more things that are good pieces of information to be aware of. Is on page 17, like we ranked the retirement plans compared to peers, we're ranking your asset classes compared to other public plans and their US equity investments, their international equity investments. Again, the goal is to be closer to 1 than 100. And some of the observations are we're primarily indexed in our domestic equity. So the ranks there are actually really good. This just shows how difficult it is to beat the index for other plans too. International equity, excuse me, a little bit lower ranks. Some of this is due to emerging markets and small cap allocations. We always take this ranking a bit with a grain of salt because the structure of other plans, international equity, can be quite different. Core fixed income ranks here in the near term that are good. Longer term, as we look at what other broad core fixed income managers are doing, your program is a little unique because you've bifurcated, you've split apart non-core fixed income and core fixed income. And in these broad market core fixed income peers, they actually combine them together. So some of the relative rankings are not going to be as relevant here. So no significant concerns here. And then finally, the trust fund pool, we're comparing the trust fund pool again, because it's fixed income centric, with a fixed income segment of public funds. And you can see how highly that's ranked, and its diversification has really helped that plan perform well. The real estate component has helped, for example, and other diversification has helped. And then finally, real estate, you can see that relative to other public plans, real estate components. So again, I just wanted to make sure that you knew that that information was available. If we look at another thing, again, back to your comment, Jack, about wanting to be aware of risks in the plans, what we've done here is to compare the performance of the retirement plans is the illustration here. And one of the things that a lot of plans became very aware of in the great financial crisis is how much dependency their return patterns had and their exposures had from having a large degree of similarity between their returns and one market, which is the S&P 500, that's US equities. So we capture this relationship with a measure called beta that measures how sensitive the retirement plan's returns are to the movement of the S&P 500. And we track that to make sure that we aren't growing independence on one particular market. And on this page, you can see at the bottom of page 18, the green dotted line is the retirement plans. And you can see that that beta number has been pretty similar, has fallen a little bit as we got into 2017 and 18. This was by design as you added more diversification to the portfolio. So again, we're watching this to make sure that we don't get any surprises in terms of over dependence on one particular market. Page 19 has the trust accounts detail. That's that 8.8 million. I just wanted to point out the Treasurer's Fund and the State Fund insurance portfolios. We spoke about the State Fund just a few minutes ago. You can see their relative size and how large it is compared to the other many trust funds in the portfolio. And then there's additional information. I thought in the interest of time, I would just point out a couple more resource pages for you. If you go all the way back, Savannah, to page 30. We have a section in this report for every asset class, so you can see how the whole asset class for domestic equity is constructed, all the managers that are used on the right-hand side. And then there are details that follow for all the domestic equity components. There aren't any issues or items to discuss here today, but I wanted to point out that this page was here. And there's a similar page on page 33 for international equity. There is a combination of both index and active management here. Again, that is by design as well to keep fees down and similarity to the index through buying the actual index. And that BlackRock piece, for example, at the top is one of the larger pieces of indexing in this portfolio. But we do have some active management and hope through time that those managers will add value. You can see the details behind this section. And then in fixed income, the relevant page to look to is page 37. This is your core fixed income portfolio. With just, again, one active manager here and primarily dominated and will be going forward with the internally managed portfolio. And then the non-core fixed income is on page 39. And I mentioned the high yield component was the larger piece of this particular portfolio, but we also have smaller components of emerging market debt to give you better yields, better interest rates available around the world, as well as preferred securities in this portfolio. So again, thought it would be helpful for you to be able to see that structure. And then finally, and I'll end with this on page 41, is the trust funds pool and its diversification. You've got the largest piece, 2/3 of the portfolio is the internally managed fixed income component that's at the top right-hand side of this page, but we do have that real estate component, which has been very helpful at 23%. You've got some high yield managers in there with Neuberger, Oaktree, and Shankman. And then you've got some cash in this portfolio. So again, there's details behind each one of these sections, and then there's actually snapshots of each manager that you have for all the liquid managers in the back of this report. But if I were to summarize, the year 2022 was a difficult year. The fiscal year to date, again, is capturing part of that year with one difficult quarter and then a positive quarter. We're hopeful that as we move forward and the Fed continues to fight inflation, that we will not enter a deep recession. And if there is a recession, hopefully we'll be on the milder side. But as we roll forward, you are performing very well relative to peers and relative to your indices. And there aren't any significant recommendations for you to think about today. Mr. Chairman, that's the end of my prepared remarks.
Well, thank you, Becky. That's thorough. I just want to make sure that there's no other questions that anybody has for you. Any questions? Well, again, thank you.
Thank you.
And as a general rule, we usually see Becky or somebody from their firm in person, so we'll look forward to that. So we're going to try to finish up today, but I think it'll be better, so John doesn't put us to sleep, that maybe we can take maybe a 10-minute break just to get up and walk around. And then we'll start with John's report on tab 8. So we'll see you all in about 10 minutes.
All right.
You're on mute, Jack. There you go.
Does it look like everybody's back?
Yes.
I think we're all back. So we'll get started on tab 8. Go ahead, John, and I'm sure you'll have other people present, but we look forward to hearing from you.
All right, thank you, Mr. Chairman. So as you said, tab 8, the investment updates. I'm on page 4, the CIO update, economic environment. So it's always tricky when we send this deck out 3 weeks or so before we actually have the meeting. And of course, everything on this economic slide seems like it has changed in the 3 weeks that we've had since. But I think the basic message that I was trying to convey holds nonetheless, which is that the market is still grappling with the direction of the economy. And there's a lot of mixed data out there regarding whether we're going to have a soft landing or we're going to have a recession. Is the Fed going to be able to tame inflation or not? And all those types of things, which Becky also talked about a little bit. So I don't know that there's any huge takeaways here, other than maybe I would mention, as I kind of go down the list here, leading economic index was starting to look like things were kind of rolling over. The Atlanta Fed GDP Now forecast, which is sort of a real-time indicator, or if that's the intent of it, was at 0.7% growth 3 weeks ago. Now it's at 2.5%, given some of the data that we've had come out. So a really big change there. The job growth number of over 500,000 in January was a big surprise to the market. Much stronger than anybody was anticipating. Retail sales, which had been weakening, jumped up 2.3% in January. So that was a big reversal as well. Inflation has continued to come down, but it's still elevated, significantly, certainly, as Becky was talking about, not at the 2% that the Fed wants to see over the long term. we're still well above 5 on the headline number, and even if you take that X food and energy, it's still relatively high and not near where they want it to be over the long term. Housing, of course, has remained weak, and then currency, which had been weakening, the US dollar started to strengthen again pretty significantly. But if you look at that long-term number, it's still much stronger than kind of what we've seen historically. So if we turn to slide 5, inflation really has been the driver here and how the Fed thinks about things and reacts. And I'm struggling with the mouse. But the big divergence here has been inflation in core services has still remained pretty high, whereas core goods has certainly come down. But there's a significant gap there. And so I think inflation has been stickier than what the Fed has anticipated it was going to be, at least early on in this process. And that's starting to be recognized a little bit more now, as we've seen them even today come out with the minutes of the Fed meeting showing that they were still a little more inclined to continue hiking rates for the next probably 3 meetings or so, albeit at a slower pace than maybe what they've been doing. There's still some wood to chop there. Slide 6, wage inflation also remains above average, and labor force participation remains below average. I've been talking about this for a while, but I think it's notable still that, we have not recovered the number of people that were in the labor force prior to the pandemic. And it's been slowly trending up, but we've still got a ways to go. And then additionally, wage inflation has been increasing, and wage inflation is important because it tends to be the driver of inflation overall in the economy, because if people have a job and they're making more money, they're going to go and spend that money ultimately. So hard to see in some ways how the Fed gets inflation to come back down until they put more of a damper on employment and wage inflation. Slide 7, as I mentioned, the dollar remains very strong versus major currencies. That had been coming down. I think the most notable thing here for us has probably been I have maintained a little bit of an overweight to international equities versus domestic because of that, because there's a tailwind there in addition to sort of where PEs are, as Becky was talking about before. There's also potentially a currency benefit from if the dollar weakens further, and it looks like, long term, it probably should. It doesn't mean it'll do it in the short term, but there would be a little bit of a tailwind to international as international currencies strengthen versus the dollar. So we've kind of held that overweight a little bit here over the last several months. So slide 8, start to get into the update for the overall assets of the pool. Those of you that have been on the board before hopefully noticed that there's been dramatic changes to the overall packet here that we have given to you, and that's been driven by Solovis primarily and our ops team. So Matt and Aaron, Tim have spent an enormous amount of time, as well as everybody else, kind of redoing the slide deck. I hope it's an improvement. Would certainly be interested in your feedback. I think most of the things that you saw previously are still in the deck, but hopefully a lot more graphics here and a little bit easier to digest than maybe the written bullet points and things that we tended to have more of previously. So happy to hear any comments there if you had any, but if not, I will launch into.
John, I just say, I think it's a tremendous improvement, and it's a lot easier to read.
That was the intent. Hopefully, and there's still, I think, some tweaks to be done. We keep looking at it and we'll continue to look at it. There's probably a few things that we need to adjust for the next go around, but all in, yeah, hopefully a big improvement. So slide 8, just showing you the overall assets under management here, a little over 26 billion, broken down here by asset class. So you can see that our investment grade fixed income, if you think about that as STIP, our money market fund, and our core fixed income assets, nearly half of our overall portfolio, of course, as we've talked about, driven a lot by a lot of our separate accounts, which aren't allowed to invest in equities and other things. But certainly sizable allocations to all the various asset classes here. If we turn to slide 9, same basic slide, but broken down by participant. So you can see the pension, clearly the biggest participant that we have, treasurer's fund being next, which is really the general fund money. Then our local governments, which are primarily in the STIP portfolio, state agencies that can own their own STIP balance. There, state fund, of course, that we talked about earlier, poll tax trust, DNRC, and you kind of get into a myriad of other participants, which we will break that down into some additional detail when we start talking about the separate accounts on some subsequent slides here. So slide 10, net asset value for the various large pools that we have, CAP, the separately managed accounts, the trust fund investment pool, and the short-term investment pool. You can see, of course, the CAP, the pension plan, has continued to grow over time. Separately managed accounts and trust funds, not a whole lot of growth here overall over time, because generally, as you know, those particular accounts, generally they're eating their income. So the principal's inviolate in most instances, and they don't touch that, but they're using the income from those programs to do whatever they're tasked to do. And then, of course, the enormous growth we've had in STIP, primarily from kind of the COVID era on here, where we got a lot of stimulus dollars and then a lot of infrastructure dollars as well. So that has resulted in some really big jumps in STIP over the last 3-4 years here. So slide 11, getting into the pension. This would be the asset allocation. You can see that we're well inside of our policy ranges in all of our different asset classes. That's the primary point of this slide, I guess. Not much else to say there. Slide 12, a little more detail about the pension asset allocation itself, what we hold, where we hold that. 13.5 billion all in for the pension itself. Slide 13, we get into net performance. So if you look at this, we show this every time for the pensions here, and you can think about this as your, well, there's the 1 year, 5 year, and 10 years we go across. I think it's more helpful generally to look at the 5 and the 10 year, but the 1 year is, I guess, informative in terms of what happened in the short term. But the DVA, dollar value add, you know, that's how much did we make in income and capital gains? You know, what was the return effectively of the portfolio over that time frame? Obviously negative for the 1 year, but you can see over the 5 and the 10, we've had, you know, strong additional growth in the assets under management. And then the net cash flow, of course, is the benefits that we had to pay over the course of those time frames. And so not an insignificant number, but particularly over the longer time frames, we have, you know, more than been able to pay benefits from the growth that we've managed to accumulate in assets under management. Questions about any of that? All right, slide 14. Performance here broken down again over various time frames. You know, Becky already showed this to you in the RVK report, but main point here really is good long-term performance, and most importantly, we're meeting or exceeding our actuarial hurdle over the long term. And really that is ultimately the yardstick by which we measure ourselves. You know, we certainly look at benchmarks and peers and all of that, as Becky talked about, but ultimately we need to hit our 7.3% and pay benefits. So slide 15, we take a look at the assets under management, excluding CAP, or the pension portion of the portfolio. And again, you can see, you know, the various clients here that we have. So this is really broken down by clients. If we look at, you know, around this wheel, and we think about some of these, you know, maybe smaller clients, DNRC or TPHHS or MSU, any number of them, there are multiple separate accounts underneath a lot of these clients. So DEQ, for example, probably has a dozen. Historical Society has 15, 16 different accounts. And so there's actually like 70 separate accounts that we manage under all of these different clients. So questions about any of the breakdown here?
Hey, John, this is Mark. Quick question. Those state agencies, local governments, and the treasurer's fund, those are basically STIP?
Yes, so the state agency number there would be all the agencies that can have their own STIP accounts. You know, not everyone, if they can't have their own STIP account, they're in treasurer's fund or the general account.
Okay.
So STIP is probably mostly made up of, if you look at that wheel, it's probably mostly made up of treasurer's fund, local governments, and state agency.
Right, okay.
Most of that would be STIP. Okay, slide 16. Taking a quick look at the STIP portfolio, you can see the diversification among the various sectors, you know, well diversified among all of that. Weighted average maturity of the overall portfolio was 67 days at quarter end. So think of that as, you know, essentially 67 days for the entire portfolio to reprice. So if you're thinking about the Fed raising interest rates, it takes us about 67 days to fully take advantage of those higher rates and have that all roll over.
So I have a question on that, John.
Yeah.
That 67 days maturity, how does that relate to historical? I mean, is that generally what the maturity is, or
it's, you know, it's probably a little bit longer, I think, than historical.
But that's by design, because you also have the 365 or 3-year assets in there too now.
Well, so when we're talking about the weighted average maturity, it would take into account, so we would have a lot of, say, floating rate debt that's maybe 2-year paper, but the reset is quarterly. So every 90 days you'd get a reset there. So.
Mark, I would just mention that you might recall, I think it was during your tenure that we came to the board and asked to change the maximum weighted average maturity from 60 days to 120 days.
Right.
So we had been bumping up close to the max for quite some time, and now we're just slightly over it.
Okay, but you got room to go farther.
Yes.
Yes.
Okay.
So STIP reserve about 62 million at quarter end, and I would just note that we're within all the policy guidelines within STIP. If you look at page 17, it's kind of a similar slide to what we look at for the pension, but really what it notes here most is that the net cash flows into STIP have been extremely large, primarily over that 5-year time frame, and most of that probably within the last 3 years. Returns obviously are not huge here because we had rates that were close to zero, although Kirsten would like me to let you know that we're now making $1 million a day in interest for STIP, so it's getting better as rates go up. Questions about the STIP portfolio before I move on? All right. Trust fund investment pool. Similarly, we're well within our policy guidelines. You know, up towards the top in real estate, as I think John's talked about in the past, we probably got there quicker than we thought we would, but that's been a good thing, as Becky noted, in terms of the overall returns over the last year. So that's been a positive for us. And what's else to say about that, I guess. Slide 19. You know, this is probably the net performance change. The asset changes here are a little less meaningful because there's so many different accounts that are coming in and out of STIP. What I would probably point your attention to most is at the bottom of that slide, there's a section called yield. And that's really what is the distribution from the trust fund investment pool that goes out to participants. And so that's not it doesn't take into account the swings in the market value. It's just how much cash is spinning off to those accounts each year in terms of interest payments or lease payments, et cetera, from the real estate portfolio. So you can see that it's been, you know, little over 3% for the 10-year, was kind of coming down for a long period of time. We put more real estate into the portfolio, which actually had a little bit higher yield than a lot of the fixed income assets. And so that's come up a little bit over time. But most notably, I think, is that that's a fairly steady return to the participants in terms of the cash that they have to implement their programs. And that's really what they care about and want to see. Questions about trust fund? All right, slide 20, state fund investment pool. So mostly within our policy limit here, but as we've talked about before, at the end of the quarter, we were a little over on our real estate allocation. So we were 8.4%, where as opposed to a top end range of 8% for the real estate portfolio. As we've talked about, that's really nothing that we specifically did. It's a denominator effect. So with the dramatic drop in both equities and fixed income, and real estate actually doing very, very well, it pushed, you know, the value of that real estate piece got pushed up over the top of the range. We have redemption requests in from our managers in order to bring that back down. And actually, we are in compliance at this point. It's come back down just below that 8% top end of the range during this quarter. So we had some redemption activity in early January, and then we've had, as Becky was talking about a little bit, you know, such a good rally here basically in the last couple months anyways, that's balanced us back out to where we would kind of expect to be. But we will continue to kind of trim that exposure a little bit. We would prefer that be down more like 6.5% probably, so that we have a little more room at the top of the range. Slide 21. State fund performance. So, you know, change in the value of the assets is consistent really with the performance overall, and the net cash flows, the negative net cash flows that you see here are primarily driven by their dividend payments that they send out every October-November timeframe. Questions about state fund?
I have a question here, John, and you know, I've been thinking about this. So in discussion with Becky, we looked at domestic equities and the PE ratios are still elevated, but then we looked at the international PEs and they were pretty low. Yeah. So is that there's a bargain to be made there by investing in international? Because I see that, especially on the state fund portfolio, it's on the lower end, but on the cap, it's at the higher end of the range. But just an observation or a question, I guess, is there a play in international at this time?
Well, you know, a difficult question because you never know for sure, I guess. Some people would certainly argue that international is cheap for a reason to some degree or another. Obviously, the war in Ukraine put a huge damper on the European markets, and China and the competition that we've seen between particularly the US and China, you know, the certainty of returns there has become much more questionable. But that said, I mean, like I said, we've been a little overweight in international within pension. And I would say similarly, I guess, although, you know, to a different degree, international was probably maybe, let's say 2% in state fund a year ago, and we've allowed that allocation to just keep climbing, whereas we have trimmed periodically the domestic equity side of that equation, particularly, and this has been true in pensions as well, particularly over the last couple of months here, as we've kind of saw domestic equities start to recover more. And I felt like, maybe the market getting a little overly optimistic about how well things were going to go and the prospect of a quote unquote soft landing for the economy, et cetera. So we've probably been better sellers, generally speaking, of domestic equity, and then probably leaving, letting international ride, I guess, if you will.
Okay. Okay. All right, thanks.
Yeah. Other questions on state fund? All right. So slide 22, just kind of a few things going on, I guess, with us here. As I said, market, I think, remains very concerned about the path of monetary policy going forward and the possibility or the severity of a recession. And that seems to be a daily debate back and forth that drives the market right now. Aside from that, we've been onboarding the Backstop research management system. So it's a CRM system for private investments, real estate, real assets, where they're able to track their managers, track all their interactions with managers, upload the documents and things that they need to evaluate a particular fund. And so far it's been great. And we've really just kind of started to scratch the surface there. We did give up a couple of other research things that we had in order to pay for Backstop. So we gave up Gini Credit, which we weren't using a whole lot. And we gave up Capital Economics, which we also weren't using a whole lot. And essentially that was pretty close to the cost of the Backstop system, which I think is going to be a huge time saver for the private teams, liquid asset teams. Questions about that, I guess, before I jump forward. All right, as you know, public markets hiring a convertible bond manager. We have hired them, I guess. We've signed the contract at least. Jason will give a little more color there when he gets to his piece. And as we talked about, kind of a continuing evaluation of our international equity managers and our fees and our structure there. Continued good progress integrating Solovis Risk. As I mentioned, Matt in particular has been just dynamite at putting together all the data here for a lot of the board book stuff and manipulating it the way we want to see it and need to see it. So that's been really good. And still a lot more to do there, but feel like we've made great progress. Have been assisting the executive director and clients as needed on legislative proposals or any ad hoc requests. They come in regularly. We hear cursing down at the end of the hallway, and then miraculously he pops into our office and we do a little fire drill and he feels better, and we give him a cookie and he goes on his way.
Evaluations are already underway, board members. We'll have those early this year. And then I think, as we've told you, Sam Holman transitioning into the fixed income analyst role, came over from our accounting side. So glad to provide those opportunities for people when it works. And Ian Horwood has been promoted to investment analyst level 3. As Dan was mentioning earlier, Ian's been just killing it. So he's doing a great job, and happy to move him up along the PGP, and confident that will continue. So any other questions of me before I turn it over to Aaron for macro attribution? All right, seeing none. Aaron, are you on the line?
I am. Good afternoon. Aaron Kirpin here, Director of Investment Operations. Typically, when I go over macro attribution, I just refer to the key takeaways tab, and I will this time as well, but for the benefit of our new board members, I might go into a little bit more explanation and detail, but feel free to stop me at any time. So macro attribution is a way of breaking down our pensions return, in this case, the calendar 2022 return of negative 8.5% into the different decision-making components that went into it. So that first decision level is the strategic asset allocation component. And what it tells us is the approximate return that would have been achieved had we passively invested in the asset class benchmarks in the middle of their strategic asset allocation range, or what we call midpoints, that John has recommended and you, the board, have approved most recently in December. You'll find that the strategic asset allocation is the primary driver in returns over the long run and usually over the short run as well. This 1 year period, strategic asset allocation return of negative 11.3% certainly illustrates that. One more thing I'd point out is that this is a theoretical return, as it would be very difficult to actually perfectly invest in our benchmarks, or in some cases, it's not 100% possible, such as with the real estate benchmark, the NCREIF ODCE. The second decision level is what I call tactical asset allocation. So we have ranges for the asset class allocation, and this tells us that additional return that we would have earned had we invested in our asset class benchmarks at our actual asset class weights rather than the midpoints. So did our overweighting or underweighting relative to the midpoint add value? This is typically a relatively small contribution because John has us rebalance to the midpoint, mostly through the liquid asset classes, periodically throughout the month. We're not able to buy and sell the illiquid asset classes like private investments in real estate quite as quickly. So those are driven more by pacing. So they make it a little more difficult to get real close to the midpoint in those asset classes. Now, what this tactical asset contribution will show you is if we're to be making any large bets away from a midpoint in an asset class. For example, if John wanted to heavily overweight or underweight domestic equity, it would show up as a large effect here, one way or the other. And we don't really make those bets, right? But if we were to do so, it would show up. So it kind of acts as the governance supports there for you to see if that were to happen. So in 2022, we were slightly overweight real estate and private investments, while being slightly underweight or at the midpoint for the remaining asset classes. And it added about 25 basis points, so a relatively small amount in terms of our overall return. The third decision level is the style selection of benchmarks within an asset class. So when we hire a manager within an asset class, we assign them a benchmark because they don't always manage to our asset class benchmark, or they have a more specific expertise. This tells us how much that decision of the manager's benchmark added value versus the asset class benchmark. So for example, in international equity, we had slightly higher exposure to developed growth benchmarks than our asset class benchmark has growth exposure. And that was the primary reason for the international style underperformance of about 12 basis points. I think I'll move on to the final decision level there if there's no more questions. So manager selection tells us how the portfolio manager selection added return over their portfolio benchmarks or their style benchmarks if they had any. So for example, in international equity, there were some managers that did well and some didn't do well or didn't do real well. But overall, their overall performance detracted from the pension's return by about 13 basis points. Other notable one, I guess, within core fixed income, our internal portfolio was a relative significant outperformer, adding 16 basis points at the overall pension level. So the main thing you'll notice here each time I do this is private investments is going to be by far the main contributor to manager selection outperformance. And most of it can be attributed to the lag in pricing of private investments. So when public equity benchmarks are down, we can expect the privates to have a large manager selection effect, positive selection effect, and vice versa. But hopefully over long periods of time, we're seeing value added there. I guess the other thing I'd point out for this period is real estate had unusually small effects this period. Usually that one is also due to that lag in pricing, has larger effects. That's all I have. If there's no questions, I would pass it on to, I think we have Jason next. Thank you.
Good afternoon, Mr. Chairman, members of the board. For those of you whom I have not met, I am Jason Brent. I am the Director of Public Markets. And I will be starting with domestic equity on page 26. As you've heard before, the real driver of the markets in 2022 was inflation. It was expectations of what the Fed rate hiking might be. And anytime you see a little change in those, whether it's maybe a little better CPI news, you get a little more positive. And then more recently, we've seen a little bit maybe not so positive news in the inflation front, and you see a little more negative sentiment in the markets. But that really was the driver of equity markets and fixed income markets too in last year. A big rotation, prior to COVID and through the early part of COVID, there was a massive outperformance by large cap growth stocks. This year, really, it was reversal. Value stocks outperformed growth stocks by a wide margin. And at least comparing the S&P small cap to the S&P 500, small caps outperformed. Now, it depends on what index you're looking at, because the Russell 1000 large cap versus Russell 2000 small cap told a different story. And largely that was due to exposure to some of the micro cap unprofitable companies that really got hurt severely in last year. Page 27. We are all index strategies as of November of 2021. And so the differences you see in sectors are very minor. We have a modest overweight to small caps, which was a benefit, at least in the pension portfolio for 2022. That is something that we can manage through index funds and ETFs, our exposure to large caps and small caps. Page 28. Again, the reaction to interest rates led to a drop in price to earnings ratios. So you can see what's happened more recently. We actually had positive earnings growth in 2022. And so that reaction to interest rates really led to a significant drop in the price to earnings ratio. And Mark, you'd asked what the current price to earnings ratio was, at least. So the graph is the trailing price to earnings ratio. So it's the price of the index relative to the last 12 months of earnings. The forward PE ratio would be estimates for the next 12 months. So the current, as of yesterday, the forward PE was 17.6, which compares to a 25-year average of about 16.8. So a little bit above longer term average.
Those still elevated.
Higher, yeah, higher than, well, the last 25 years too will give you a different, maybe higher long-term average than what you would do. I would see if you went back to early 1900s. And I think Becky mentioned that and showed some of the graphs of much longer time periods, what price to earnings ratio would be. Now, granted, the composition of the market today is very different than it was 20, 30 years ago too. So that has a part too.
So Jason, give me the same metric for the international as well to look forward.
I don't have that. I can find it for you. I don't have it right now. It's
fine, thanks.
I think it might be at the back in the appendix, I think.
Okay, well, look. Okay.
It's less.
Send it to you.
Yeah, we can follow up with that. We'll follow up.
Okay.
Any other questions on domestic equity? I'll move to page 29. International equities. The dynamics in the US, obviously the reaction to interest rates and inflation. International markets recently have also been dealing with fears of an energy crisis in Europe, as well as commodity price shocks and geopolitical tensions and war. But it might surprise the average person that international stocks actually outperformed US stocks last year. And a lot of that was largely due to the fears of a worst case scenario with respect to energy supply in Europe was averted. Valuations at a deep discount to US stocks, and at least in the latter part of the year, a weaker US dollar, all provided a little bit of a tailwind relative to US stocks. Emerging markets underperformed developed markets for the year. China was a big contributor to that, as well as other parts of Asia related, to China that were hit especially hard. And we mentioned that we did make one roster change in our manager lineup this year. And we have liquidated our international small cap portfolio with Franklin Templeton. And really the reasons were we were looking at the structure of our international portfolio, and we want to have meaningful allocations. And we also thought that there were better alternatives we had within our portfolio in terms of exposures and performance, as well as an opportunity to have some benefit of a reduction in fees. And so that's reasons that we made that decision. Page 30 shows the characteristics just real quickly. In the top left corner, you see our exposure with developed markets versus emerging markets. The emerging market, in actuality, exposure is probably closer to neutral to the benchmark. There's just some classification issues when it might classify an ADR or something depending on its listing as developed markets when it really is emerging markets. So we are close to neutral with respect to emerging markets, and that is largely an output of our managers' decisions. It's something that we haven't typically managed very actively. Our exposure to emerging markets is something we can do, but we've chosen to leave that up to the managers to make the decisions in terms of their exposure to developed markets and emerging markets. And we do have a very slight overweight to small caps and a 50-50, roughly a 50-50 split between active and passive. Page 31 shows you, and this again is the trailing PE ratio, which you can compare. This is currently, well, at least at the end of last year, was 12.4 versus close to 18 for US stocks. It gives you some idea of relative valuations between international stocks and US stocks, which is a historically large discount that we've seen. Part of that is there's more value than growth in international, which typically has lower PEs, more cyclical companies, and as we've seen too and talked about, the geopolitical tensions, so forth, also having an impact on international valuations. Any questions about international equities? I'll move to page 32, non-core fixed income. So prior to the COVID period, we had a period of very low high yield spreads, very stable, and then that changed with the COVID period, and then last year we saw a pickup in spread volatility. But really the reaction again was to higher interest rates, that the market was more concerned about higher interest rates than it was really about credit risk this last year. And interesting to note too, that I mean, part of it, you see that with the difference between high yield returns and investment grade returns, that high yield returns actually outperformed investment grade for last year, which you would wonder why would presume to be riskier credits outperformed lower risk in such a down year. And that's generally due to a shorter duration for high yield bonds, duration being interest rate sensitivity. So high yield bonds having shorter duration, less interest rate sensitivity actually outperformed for the year. For the pension portfolio, you see the performance relative to the benchmark. Our high yield managers performed well last year. A conservative approach paid off, that they had some measure of downside protection in a down market. The exposure to preferreds and to emerging market debt was a drag on returns relative to the asset class benchmark, as preferreds and EMD both underperform high yield, and EMD by a large amount, although that did reverse and had a big rebound in EMD in the fourth quarter, which performed, I think, over 10%. Page 33 shows you the characteristics. Some of these differences really, so this is the asset class benchmark is a high yield benchmark. So layering in preferreds and emerging market debt gives us different exposures versus the benchmark, different sector exposures, more financials for preferreds, and exposures to sovereign bonds that basically are not in the high yield benchmark. On the right-hand side, the credit rating exposures, preferreds and emerging market debt have much more higher exposure to investment grade bonds, which is really are not included in the high yield asset class. And you see the exposures by the different asset classes, high yield, EMD, and preferreds there in the bottom right. Page 34 shows you the history of spreads. Again, spreads have tightened. They're not at very low levels. They're not high levels. They're kind of in between that roughly long-term average, but obviously the average is thrown off by some of these periods of stress that you see around the GFC back in 2008, 2009, more recently in 2020 with COVID. But on the positive side, while we did have some spread volatility last year, we actually have high yields and high yield bonds, which currently our portfolio is yielding about 8.5%, which is much more attractive than what we've seen in prior years. Any questions about non-core fixed income? I will discuss our hiring of a new manager, a convertible bond manager in the non-core fixed income asset class. We had looked at convertible bonds a number of years ago, or several years ago. We looked at a very small slice of the universe, and which really there were only a few managers that were in that part of the convertible bond universe. More recently, we reopened the process. We looked at a broader subset of managers within convertible bonds, and we found Zazov Associates, which what we liked about them, they are convertible bond specialist. That is all the firm does. The whole firm is dedicated to convertible bonds, as compared to a lot of their peers would be maybe a couple of portfolio managers within a large organization sitting in between the fixed income team and the equity team. But Zazov is convertible bonds, and that's all they do. They have a very long track record. The portfolio fit we thought was good. Not to get too detailed into the dynamics of convertible bonds, but certain managers have much more equity sensitivity in their portfolio. Others have much less. We were looking at more managers more in the balanced area, and Zazov's approach was relatively conservative. So they tend to have less equity sensitivity, which compared to peers, which we thought was a better portfolio fit for non-core fixed income. And which means that there will be certain times that they look very different from the benchmark, but they've been very consistent with their philosophy over time, consistent with the process, and a much less volatile track record and more predictable. And we expect to fund them within the next few weeks. Any questions about our recent hire?
Yeah, Jason, I've got a question on the write-up here, the investment philosophy and strategy. That last line, can you explain what you mean by that? The strategy has managed to create a portfolio of desirable risk-reward characteristics and not based on a particular benchmark. So who sets the desirable risk-reward characteristics?
Yeah, so that's one of the things about the convertible bond universe that we like, that the convertible bond basically is, you have a bond plus equity call option. And that bond value provides you some downside protection versus a stock. So the stock may trade off, but you still have that bond value that provides a floor. So there is a positive skew to that risk reward and convertible bonds. Okay. Where they might, at least with their process, is when certain bonds get much more equity sensitive, that risk reward dynamic changes. And so there is more risk than reward, and they will harvest proceeds out of those more equity sensitive convertible bonds into ones that are more balanced and have a better risk reward trade-off. Does that make sense?
Yeah, okay.
So Mark, when you think about it, these securities, they either trade kind of towards to the bond value or towards the bond value and trade like a bond, or they tend to trade like an equity because people are looking at them as a conversion. And so it slides up and down that scale, like what Jason said. And that's, you know,
and that's how this going to manage his portfolio then towards that skewing and try to maximize that risk reward.
Right. They're always they look a lot at the downside, and they're trying to, you know, essentially, I guess, if you will, pay for the bond. And then if it does really well and you get the equity upside where it looks like it's going to convert, then, you know, you kind of hit a home run, I guess, if you will. Okay. So they're looking for that type of dynamic to occur within their portfolio.
Got it. Thanks.
So when we looked at convertibles, you know, back in 2018, I think it was, we were really looking at managers that were more bond-like, which would, you still have that downside protection, but I think probably maybe more limited upside than a balanced manager. And the other factor was if I said there were a handful of managers that do it, I'd be overestimating. There were a few that we thought were investable, and several of them that we just didn't think were worthy of our investment. So.
Okay.
Good afternoon, everyone. Am I coming through okay?
Yep.
Great. Well, I apologize for not being on camera, but I will look forward to meeting everyone in person at our next board meeting. Ethan Hurley, I'm the Director of Real Estate and Real Assets, and I'll be taking you through both portfolios at a high level today, and look forward to any questions you have along the way. So we'll start on page 36 with the real estate ownership breakdown. You know, the charts speak for themselves. I won't go through those in great detail unless there's specific questions, but I'll just talk to you broadly about what's kind of happening in real estate and reiterate some comments that Becky noted earlier in her presentation. But essentially, real estate's going through a repricing. Given the rise in interest rates, everybody's a little bit gun shy. As a result of that, the markets, the capital transaction markets have largely come to a bit of a standstill. I think commercial real estate transactions in the quarter were down on the order of 70% relative to the fourth quarter in 2021. There's a lot of price discovery going on in the market. Lenders are very tentative and will only lend on those deals that have very visible contractual leases in place, positive cash flow with good tenants. But for the most part, everyone's kind of shut down. You know, activity is at a trickle while people are trying to rationalize what can only be described as a very large bid-ask spread in the market, where seller expectations are still very high while buyer expectations are, you know, actively ratcheting down their purchase price offers to sellers, and people are at this point still relatively unwilling to transact. In addition to that, fundamentals being things like occupancy, vacancy rates, rental rates are beginning to ease. And what I mean by that is they're adjusting downward to more normalized trends. I'd say over the last 24 months, we had seen in some property types, in some locations, parabolic rental growth, the likes of which practitioners who have been in the business their entire careers, 30, 40 plus years, have never seen. So think, you know, 40% rental rate growth in some markets in industrial. On average across the entire multifamily market, last year we saw rental rates increase on the order of 12%, in some locations 25, 30%, and those rates are normalizing and coming down. Happy to answer any questions on 36. Otherwise, we can shift over to 37 as per for the presentation up in front of you currently. Hearing none, I'll just maybe at a high level let you know that the real estate portfolio is very diversified across sectors and across properties. I think at last count, we were just over 1,800 individual properties. Everything, according to the chart up top, is within the range for our strategic or investment policy statement. And I'll just let you know that the chart in the lower left, real estate over time, is only representative of our private market investments within real estate. So the NAV growth is just representative of our private investments and doesn't capture our public REITs and our publicly traded CMBS, high yield CMBS exposure. If there's questions here, I'm happy to address them. Otherwise, we can keep rolling and we'll move over to page 38. Hearing none, I'll just, you know, I captured this chart here from CBRE. They are a massive research, property management service provider, investment manager in the business. They're also an investment manager of ours. This is a historical representation across a multitude of property types and cap rates over time, and sort of their projection of cap rates moving forward. And noted earlier, we are in an adjustment period where prices are moving up, and there's a lot of price discovery still trying to occur in the market, with that bid-ask spread rationalization yet to occur, and people to come to terms with the new reality that is continuing, and frankly, it's fluid. It's anyone's guess when the Fed is going to stop raising interest rates. Likely they'll stay on the gas pedal through the remainder of this year, and that will continue to likely push cap rates and thus valuations lower throughout the remainder of the year. Any questions? Hearing none, we can go on to page 39. So since we last met, we've made one new commitment here in front of you is a representation of all the real estate investments we've made fiscal year to date. Bell Value Add Fund 8 is our newest commitment. Bell is, however, an existing manager of ours. We have been with them since their Value Fund 6, into which we committed $20 million back on June 15th of 2017. We re-upped with them in September of 2019 for an additional 30 million. And we also committed to their core fund back in March of 21 with both the pension fund and trust fund at 80 million and 50 million respectively. Bell is a vertically integrated multifamily focused investment manager. By vertically integrated, I mean they do everything from leasing to property management to running their acquisitions, dispositions, financing, construction, etc. They've got a very long track record. They've been in the business since 1976. They've had a very stable team. They're 100% employee owned. We like the multifamily space, just given some of the structural supply and demand issues going on in housing right now, some of the affordability issues specifically in housing. Happy to answer any specific questions, but I would just say Bell is a very high conviction manager of ours. And we believe in supporting our managers in a sector that we have a lot of conviction in, and thus the at a bit of a higher rate relative to our initial investments into their Fund 6 and 7. I'll just maybe touch on that. Since the original commitments to Fund 6 and 7, we've kind of changed our stripes and become a little bit more concentrated in just expressing and being more efficient with our capital, frankly. And so 50 million is sort of our standard bite size for standalone investments in the value add space within the pension fund itself. Happy to answer any specific questions.
So Ethan, I have a question on this Bell thing. So we have $280 million still with them through all these funds?
That 280 million you speak of is representative of our total commitments with them. Yes, Mark, we have certainly received distributions through time from some of the earlier investments and income along the way. I could track down a specific net asset value that we have with them right now. Some of that money of that $280 million is invested, and some of it is what we would refer to as dry powder,
Right.
or commitments that have yet to be drawn. If that answers your question.
No, you don't. That's fine. I don't need any other information from you.
Okay. Great. Thanks for the question, Mark. Okay. If no more questions, we can roll on to real assets on page 40. So real assets is for maybe some of the newer board members, I'll just tell you it's a very broad asset class. It covers everything from things like timber to oil and gas investing to commitments that we have in a rail car fund, to commitments we have with managers who do renewable energy development projects around the world, to other things like mitigation banking, where we have a manager that goes out and spends money basically mitigating destroyed natural systems, bringing them back to their former selves and being awarded credits from the Army Corps of Engineers that then they then sell to commercial and industrial users who otherwise are negatively impacting the environment. So it's a very broad asset class, lots of different exposures here. You can see our value here, dollar value add. You can see our performance. With regard to renewables, there's been a lot of talk about that with the Inflation Reduction Act and net zero. I would tell you that specifically as the director or portfolio manager here, I do have a focus on renewables. But I would tell you that it is tilted towards ground up development versus buying existing projects or assets that frankly, there's a crush of capital seeking those assets out and yields have compressed dramatically. So I'm looking for a little bit more risk in taking this ground up development type risk. We have these investments with managers that are developing, solar fields, wind farms, et cetera, in both the developed markets and emerging markets of the world. And I would tell you that, just per this comment, the cost of these are becoming a lot more cost competitive with the hydrocarbons of the world, and they're being adopted and they're becoming a lot more attractive. In the same breath, I'll tell you, we have not lost our focus on hydrocarbons. There's been a lot of capital flight from the space in recent years, and thus represents a large opportunity going forward. Many of the majors and even smaller operators have reduced their capital budgets by dramatic numbers over the last handful of years, and there's been dramatic underinvestment in the space. And oil and gas is not going away. We still need tires for our cars, crayons for our children, plastic containers, unfortunately, for preservation of our leftover steak, and potatoes that we didn't finish the night before. And so the focus is broad. Happy to answer any questions here. I know I rambled a little bit, but just wanted to share with you a little bit of the thought process within this portfolio and sort of its scope. Hearing none, we can go to page 41. Again, we have the ranges as per our investment policy statement. We're well within the scope of our policy ranges. Similar to real estate, the bottom chart, real assets over time, that NAV is only representative of our private investments and does not capture our exposure to TIPS or inflation-linked bonds as per above, nor does it capture our master limited partnership publicly traded mandate. I'll bring your attention to the domestic versus international. And the only thing I'd really say here is I would expect that international piece will grow over time, just given some recent commitments we've made and the international scope of those mandates. So just, I can't give you any real guidance. We don't have a goal as to how we want that to develop over time, 50-50, 60-40. It's very opportunistic, very bottoms up, but all that is to say is I'd expect to see international grow over time. Happy to answer any specific questions with regard to this slide or frankly anything real assets related. Okay, you guys are taking it easy on me. Let's go to slide 42. I was tasked with putting some slide together that conveyed to you sort of what's happening in certain of these real sub asset classes, if you will, within the real assets portfolio. I chose to bring up crude and lumber. Our timber exposure is roughly $100 million of NAV. Our energy, specifically oil and gas, is I believe, if I'm not mistaken, just north of 300 million, somewhere between 300 and 400 million. The number eludes me right now. I apologize. But look, oil remains a bit volatile. There's a lot unknown right now. Russian sanctions are what they are. We got a price cap that came down on Russian oil, a few weeks back, and they capped it at 60 bucks a barrel. We're going into a recession, arguably at the same time. China is reopening, so there's a lot of uncertainty on how that's going to play out. We've been somewhat range bound for the last, call it 5 or 6 months. But overall demand for oil tends to kind of rise at about 2% globally every year. So I I think, with this dramatic underinvestment I've discussed earlier, as things settle out and we begin to grow ultimately, maybe towards the end of this year and early 2024, and things become a little bit more clear with Russia and China, we might see oil start moving to the upside. Ergo, why I think it's still not only a great investment opportunity because it's never going away, but there's been, typically when there's capital flight from the space, that can oftentimes portend great opportunity going forward. Lumber has been super volatile. It's back down to sort of pre-pandemic levels. Happy to answer any questions. Happy to, take suggestions as to, if you want to see other sort of valuation metrics in this chart going forward. Otherwise, I'm at your disposal. Hearing none, I'd just bring your attention to page 43, new commitments. This is actually not a new commitment. This was consummated early September. As a reminder, CBRE Muscle Shell is an infrastructure separate account we set up with CBRE. It's largely focused on digital assets, but we recently expanded that to take advantage of a couple more yield-oriented opportunities within broader infrastructure. Happy to answer any questions, but we'll continue to keep you updated along the way as we add new commitments. Thanks for your time, and look forward to seeing you all in April.
Sounds good. I'll take it over on page 44. My name is Thomas Winkler, Director of Private Investments. I wanted to extend a warm welcome to all new board members. And I'll walk you through just a handful of slides on the private investments portfolio. Current market value about $2.3 billion just in the pension itself. On this slide, I'd like to focus your attention on the long-term performance, as we've heard from Becky and others previously, Aaron primarily. The short-term one-year performance is heavily impacted by mismatch of benchmarks and valuations. It's not daily traded asset class. These are long-dated investments, 10 years plus. So really meaningful is a 10-year number where we are at 13.8%. Very meaningful additive to the overall pension. Very proud of that number, even though I'm not responsible for all of it, but certainly like to point that out. We expect the overall performance to come down slightly. As I mentioned, valuations are lagging in this asset class. So year-end audited financial statements are coming out probably in the next couple of months. So we see some markdowns in the portfolio, but overall everything is holding up very, very well. I'll move on to the next page, 45. In terms of characteristics, we primarily invest in direct funds. When opportunistically consider fund-to-fund investments. We can go into some details there later if there are some questions. You see our ranges primarily driven by buyout, private credit, and venture capital. 64% of the portfolio is in your classic control buyout investments, which you would expect. Also, the domestic versus international chart on the bottom right. You can see it's a US-centric portfolio that is by design. The US market is one of the largest private investments market in the world, and we're heavily invested there. We will opportunistically look at other international markets to take advantage of macro themes or other tailwinds that you see there. And we expect that international number to stay somewhat consistent or slightly increase going forward. If there are any questions on this particular page, I'll move on to 46. Evaluations or overall market environment. So we don't have PE ratios in private markets. I think the closest what we have would be a purchase price multiple or an EBITDA multiple and debt multiples. So those are simply, what is the manager paying for a company that they're acquiring in terms of multiples of EBITDA, or how much leverage are they putting on the deal in terms of EBITDA. The purchase price multiples have crept up, have increased over the recent years, are at somewhat historic highs, meaning that things are relatively expensive. The debt multiples, and that's, I'm looking at the right-hand chart on the top there, are relatively consistent, although elevated. Traditionally, they're more towards a 5 times. And we expect that to come down somewhat, just given where interest rates are heading, meaning that the managers in the buyout space were essentially forced to put less leverage on a deal simply because it's becoming more expensive for them to do so. Just note, when you see the averages here in the high 5.7, 5.8 range for debt, our managers in the portfolio are traditionally at least 1 to 2 times lower than that average. And that's also by design, with us focusing on prudent use of leverage and debt in these strategies, since they are inherently risky. On the top left chart, just wanted to point out, you may have seen some headlines that the deal activity in buyout markets has cooled off. It's really a tricky observation because it came down from 2021 levels. Yes, that is clear. However, 2021 was really just a pent up demand from the COVID years prior, where people pulled back a little bit in terms of their allocations, their commitments. So that was a record year, but it's not really reflective of the overall market. So I would argue that 2022, we're really just more in line with previous markets and have not seen a tremendous drop in activity. Those are all the comments I had prepared on those 3 slides. Unless there are any questions, I'll move on to the next one. Seeing none, I'm going to go to the new commitments. And again, we've seen 2 commitments so far fiscal year to date, Deerpath and Audax, which we have discussed previously. The newest commitment was EQT. That is our first designated exposure to Europe. In a sense, that is a new investment for us on the private investment side. However, we do have a long-standing relationship with EQT as a firm on the infrastructure portfolio in Ethan's real assets portfolio. EQT is a very long-dated firm that's been around for over 20 years, very successfully investing in private equity buyout markets in Europe, focusing on technology and healthcare. We made a $60 million commitment here, right in line with our average allocations and our pacing models. Don't know what else to highlight on this particular page. I'll just open up for any questions there may be on this particular investment. If I don't see here anything, then I'll pass it back to John. John.
I'll take it. John Ramasco, Director of Fixed Income. If I could refer the board to slide 48, you'll see the 13 odd billion that your internal fixed income team manages. I should note that that figure does include a relatively small amount that at the end of the year was managed by an external manager, Reams. We have since let Reams go. Just that it was a small amount, and we felt that we could do better essentially just by having lower fees, the lower fees that the fixed income team, your internal fixed income team charges. So anyway, point being is now essentially all your core fixed income is managed internally. Looking at the table at the bottom of the page, we can see the effect that Becky mentioned of the inverse relationship between interest rates and bond prices. As interest rates went up dramatically, we see the dramatic effect of negative returns in the bond portfolios. So we did perform well relatively, although Kirsten points out regularly that it was still negative. I understand, but happy with the relative performance. That was because we were short duration, short our exposure to interest rate changes. So we, for most of that year that you see, John and I had a handshake agreement that we would stay above 90% of the index in terms of duration, but we were very close to that. So if you do your arithmetic and say, okay, well, 90% of the benchmark, okay, pretty close to where all that outperformance comes. I will note for the state fund for the 1 year performance, we Before Jack insists on buying me dinner for my dramatic outperformance there, I will just note that there's an error. The 1-year benchmark for the state fund was actually minus 9.51 instead of the 13.1. So again, relative outperformance similar to the other portfolios. Any question on performance? If not, I'll go on to slide 49, where we see at the top historical risk premiums or spreads over the amount over and above treasuries that the market is assigning to corporates and mortgages, corporates in the green and mortgages in the blue. So takeaway from that should just be we saw some elevation around the COVID time period, but a decline more towards historical norms. So looking at the slide and the bottom, here you can see the dramatic increase in yields that Becky mentioned. And also what we can see from the top green line is the inversion of the yield curve, where treasuries of short maturities out yield treasuries of long maturities. So that's an unusual situation and is a unique challenge to a fixed income portfolio. We have high yields, but to lock those yields in, we would have to give up a significant amount of interest rates. So if we wanted to sell a 2-year treasury and buy a 10-year treasury right now, we would have to give up about 80 basis points or 0.8%. So difficult to navigate that.
So John, I have a question real quick. So this is a yield curve as of the end of the calendar year. Has this inversion continued on to 2023?
It has. It has, and in fact, Tim, it's gotten a little bit worse from what you see here.
Okay.
Occasionally we've hit in the upper 80s, 80 basis points of 210 yield inversion.
Okay.
Going on to some characteristics, looking at the core fixed income, we can see the duration or the exposure to interest rate change. We're short the index a little bit towards the end of the year. So that means if interest rates go down from here, we'll underperform a little bit. If they go up, we'll outperform a little bit. But that short duration bet that I had mentioned, we'd mostly taken off by the end of the year. And right now, we're pretty much right on top of the index. Our contribution to duration from corporates, contribution to duration being how much risk we're taking on corporates. You can see for the core fixed income that we're 73% of the index. So that's quite short in terms of risk. There's a reason John and I have a handshake agreement that in the core portfolio, which can often act as an anchor or an offset to the risk taken from equities, we would choose to underweight that risk. And so that if John sees an opportunity in equities, he's able to come to the core portfolio and more easily take cash from that to allocate to what would likely be asset classes with higher returns. Going on to slide 51, same table for the trust fund, but a couple of things to note is the contribution to duration from corporates is very close to the index. Finally, slide 52. the state fund. So one thing, a couple of things that we would call out there is the duration, even to its formerly shorter index, was very light. Currently, currently we would have been about equal to the former index, but we're going to be about 80% of the new index. So a lot of work there to get that duration up. In other words, to try and lock in higher interest rates for a longer period of time. And secondarily, you'll note the significant overweight to contribution to duration from corporates or overweight to corporate risk. And so that will also be something like about 80% of the new index. And just the call out there being again, state fund spends a lot of that money, and so that's why we've taken a little additional risk from corporate credit to increase that amount that they're able to spend. And happy to take any questions. Thank you.
All right, Jack.
So John, is that it for everything that you wanted us to know?
That's everything from the investment side, Mr. Chairman. Unless
Did
have any
you
other
tell the
questions.
new board members, so you'll be sending them a test?
They thought they were drinking from a fire hose last
Oh.
week. I'm guessing this might be a level up.
Okay. Well,
So-
I appreciate everybody's attention.
So,
So
Mr. Chair,
Dan, go ahead, Mark.
does this mean I get the day off tomorrow?
No,
do.
you were the only one that has to come in. So I think we did pretty good getting 2 days worth of work in one day. But get ready to adjourn. I want to make sure, is there anything that Dan, do you have a list that you wanted to make sure you got for us?
I think the most helpful thing for us would be any feedback on the new quarterly performance reports from any board members, prior board members, new board members. If there's something in there you think would be more helpful, something in there that we weren't as clear as we have been on. We're trying to cover all the assets as opposed to being so cap focused. That would be helpful. And then just a heads up for everybody, as we've been meeting today, Tim, Cindy, Porter, and Dan, you were confirmed by the Senate unanimously. So you're official through 2027. So both congratulations and condolences. You only have 4 more years of it.
Thank you.
Other than that, Mr.
I
Chairman,
would
I think-
only say maybe in 4 years, I won't feel like I'm drinking from a fire hose. This really was like information overload. My God, oh my God, I don't know what else to say, but maybe next time I'll understand more of it. So.
Oh, don't feel bad. John's a big nerd and he just focuses on this all the time. And it's great. He's here to do that for us.
It's fun.
Any questions
Yeah.
from the board for us?
We had sent Mark the international PE
Okay.
ratio stuff for current forward. Jason.
I have another request too, Mr. Chairman. Dan, can you keep us informed on this housing bill when it comes out, so I might be able to look at it and that sort of thing?
Yep, the governor's office approved the draft today, so I bet it will be through editing and enrolling, or through editing by Friday. So what I'll do is just attach it in the next legislative update to the board.
Okay.
Cool.
Anything else?
Okay, with that, I want to thank everybody, especially the new board members. I want to encourage you to ask any questions. Our next board meeting, I think, Dan, is April 12th. And so we've got a schedule that we go through. And if there's anything else we need to be going over that, let Dan or I know, and we'll see if we can get it on the schedule. So with that, other than Mark has got to come to school all day tomorrow, the rest of you are excused.
I've got a quick question for you. What is the information like? Do we go through the same thing pretty much each board meeting, or how does the information change between meetings?
So the quarterly, these will be prepared for you quarterly. So the April meeting,
Investment update.
you will have the investment update again from both RVK and us. The deep dives, like today was cash management of state monies, that will rotate. And if you go to your book in the back under the appendix, you'll see for 2023 in April, we'll do international equities, asset class review, RVK and annual capital market assumptions, as well as benchmarks that are used by the board. So we won't actually have the quarterly reports in April. We will have those again in May for Q1.
Okay.
And April is a for sure 1-day meeting, and then we'll do the full 2-day again in May.
Okay. Good. Thank you.
You bet.
So with that, meeting's adjourned. Thank you all.
All right, thank you.
Make sure Mark does attend tomorrow.